Follow Asia into the red, set to give up Tuesday's gains as the EU becomes subject to an additional 20% levy. Long-dated treasuries sell off with a 30-year yield briefly breaching the 5% level amid fears of higher inflation and a global downturn. But U.S. futures buck the trend as Wall Street lines up a positive open. A warm welcome to the program. Let's get right to it. The U.S. has implemented its harshest tariff regime in over a century with what the White House calls reciprocal levies coming into effect on countries from Angola to Zimbabwe. Speaking last night, President Trump was defiant on the issue.
The war with the world, which is not a war at all because they're all coming here. Japan is coming here as we speak. They're in a plane flying, lots of them, all tough negotiators, but things that people wouldn't have given us 2 years ago, wouldn't have even thought of it 2 years ago, 3 years ago, 5 years ago, 7, they're giving us everything. They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%. Now, it sounds ridiculous, but they charged us for many items 100%, 125%. Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was. And 2026 Republicans will fight for every state, every seat, and every single vote. We're going to fight like hell.
Trump's Treasury Secretary Scott Bessent joined him in doubling down.
It was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
So the tariffs have come into effect as of 5 a.m. London time this morning. And here's a look at markets. European equities trading lower across the board, reversing yesterday's gains. We are just getting some lines from the ECB right now, from the ECB's Klaus Knot, saying a trade war in the long term is a negative supply shock. The impact of a trade war on the long term is likely inflationary. And the risk is that we move to a supply-demand situation like in 2022, which means we have to be vigilant on inflation. He's also said that at the meeting next week, the ECB will not yet have new projections. Market functioning so far has been preserved. So some interesting lines there from the ECB as we watch the market moves unfold here. The Xetra DAX this morning down nearly 2%. The CAC 40 down about 2% as well. FTSE 100 here in the UK, it's actually quite evenly spread across the board. From a sector perspective, there are no sectors in Europe trading in the green this morning. Every sector is under pressure. And in fact, every sector is trading off more than 1%. This is the best of the bunch. No gainers. The best of the bunch off more than 1%. Autos, the most resilient, and it's off about 1.4%. On the downside, the laggards in the market, you've got healthcare clearly underperforming this morning, down about 5%. Oil and gas down about 3.4%. The next worst performer, real estate and telcos. We're also watching luxury stocks pretty closely. Deutsche Bank came out this morning slashing its earnings expectations for the luxury sector, saying that economic uncertainty is set to weigh on confidence and further postpone a recovery in luxury demand. So the luxury names are selling off this morning as well. We've also seen some pretty extraordinary moves in treasury markets. So this has been a big focus of the market action over the last few days. Yesterday, we saw another wild session for treasuries experiencing aggressive selling, suggesting investors are increasingly doubting treasuries as a safe haven asset of choice. Right now, we're looking at the 30-year trade around 4.8%. We had reached around the 5% mark in yesterday's trade. It rose over 25 basis points in the past two sessions already. So we've seen an incredible climb higher in the 30-year. It has been been the longer dated treasuries which have seen the most aggressive selling. Investors now also questioning whether the Fed might need to step in and intervene, whether they might need to respond to stabilize the market, potentially with an emergency cut. That's all things that are being discussed right now. U.S. futures, this is interesting as well, where we've seen U.S. futures cross into positive territory, and now just on your screens there, we're crossing back into negative territory. So U.S. futures really bouncing around this morning as investors figure out where to go from here. Now, you saw there that the healthcare sector in Europe is underperforming this morning. That because President Trump says he will expand the impact of his tariff policies, with the pharma sector next in the crosshairs after being exempted from the impact of so-called reciprocal tariffs in place from today.
We're going to be announcing very shortly a major tariff on pharmaceuticals. And when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here. And they're going to be opening up their plants all over the place in our country. We're going to be announcing that. So that's breaking news. Ladies and gentlemen, we have breaking news.
European pharma companies have warned that tariff policies could accelerate a shift in investment to the U.S. A sector lobby group has called for, quote, rapid and radical action from the EU to avoid what it describes as a risk of exodus. Here's a look at the pharma names for you. You don't typically see moves of this magnitude in what is considered a defensive part of the market. You've got Novartis shares down 7% this morning. Novo Nordisk down about 6%. Sanofi down 6% as well. What's interesting to me about this is that we knew that President Trump was eyeing the pharma sector. We knew the rationale for exempting them in the first place from these reciprocal tariffs. Perhaps it's just the reality that he is planning to move ahead with these tariffs that has these stocks under particular pressure today. Now, EU member states will vote today on the first round of retaliatory tariffs against the United States in response to levies on steel and aluminum imports. The bloc is targeting 26 billion euros worth of U.S. goods, including motorcycles and jeans. If approved, the tariffs would come into effect from mid-April. In addition to the proposed tariffs, EU officials have reiterated they are hoping for open discussions with the Trump administration. Bern Lang, the chairman of the Committee on International Trade at the European Parliament, told CNBC this morning that the European Union is also looking at forming alliances with other nations affected by U.S. tariffs.
We are looking to have a more broad coalition, not only with China, but also with a lot of other countries like India, like Indonesia, or Vietnam, which are really hard harmed by the U.S. tariffs, so that we can stabilize the rule-based trading organization and the WTO as well. So we need really an open and fair partnership with a lot of countries worldwide, and we are working on that.
Emra Parker joins me now, Director for Europe at Eurasia Group. Thanks for being with us this morning. Talk to us about what a potential off-ramp looks like between the EU and the U.S. here. Specifically, what do you think President Trump wants from Europe?
I mean, I think Peter Navarro made very clear in his op-ed in the FT yesterday what they want. They want a rollback of the value-added taxes. They want a rollback of non-tariff barriers to trade. And they also want to level on transatlantic duties. That's a huge ask, and it goes into areas of competence where the EU can't really deliver. So the off-ramp looks very challenging, frankly. The EU offer is clear. The bloc is willing to go 0 for 0 on tariffs on industrial goods, which would impact hundreds of billions of dollars in trade. But getting the EU to water down its agricultural regulations or its tech regulations, or getting individual member states, all 27 of them, to roll back their VATs is going to be near impossible. So the EU can do a tariff deal. The EU can offer to buy more LNG, do more defense procurement from the U.S., and also, strategically very important, cooperate more with the U.S. on Chinese industrial overcapacity and other problems emerging from what the Western world regards as unfair trade practices. But so far, those efforts haven't really paid off, and the EU hasn't found a willing audience in Washington. So I think at the first instance, we see a retaliation, and only then we see if the U.S. administration is willing to react in a more positive fashion and engage with the Europeans.
Clearly, there is still a major impasse here and a major gap in what the EU is willing to do and what the Trump administration wants them to do in an ideal world. Yes, we heard from Peter Navarro yesterday, but we also heard from President Trump himself over the last couple of days saying that he wants the EU to buy more energy from the U.S., suggesting that maybe for President Trump himself that's paramount to some of the other asks that Navarro has put out there. He suggested that the EU would need to buy about $350 billion worth of energy to basically compensate for what he sees as unfair practices from the EU. Speaking to energy experts, they say this is a possibility. The EU needs energy. They need LNG specifically. Why wouldn't they go down this route and buy more energy from the U.S.?
Juliana, let's be realistic. The EU imported 100 BCM of LNG last year. 45% of that came from the U.S., worth about 36 billion euros. So rounded up to 40 million US dollars, let's say, even if the EU bought all of its LNG from the US and doubled it, it still would get to roughly half of what Trump is asking them to purchase. So only energy purchases and defense procurement isn't going to close the gap. Some of this is baked in due to structural makeup of economies on both sides of the Atlantic, and we are completely disregarding the fact that the U.S. is running a 100 billion euro surplus on services trade. So, on balance, if you look at the EU-U.S. trade, the EU surplus, if you take both goods and services into account, is only about 50 billion euros in surplus. So that's chump change in 1.5 trillion annual trading relationship. So I don't think it's easy to meet Trump demands, although during his first administration, we have seen that market forces working to propel more European purchases of LNG and soybeans from the U.S. and some minute deals around Maine lobsters and bits and bobs here and there were sufficient to appease President Trump. So there's hope on the European side that more can be done and it would work at some point. But first, I think, comes the pain because appeasement so far hasn't worked.
Well, I certainly appreciate the numbers there, putting them into context, and the fact that what President Trump is suggesting is nowhere near what Europe needs on the energy front. So appreciate the facts there. Let me come to services then. Do you think that Europe is likely to go down the path of retaliating on U.S. services, given this is potentially the real pain point for the U.S.?
I think if we end up on an escalatory path, which all signs point to right now, then the EU will have no option but to retaliate against services because that'll be the real pain point for the U.S. economy and politically for the Trump administration. If you look at the makeup of European imports of American goods, about 350 billion annually, a third of them the EU can retaliate against without inflicting too much pain on its consumers or its own industries. But the remaining two-thirds are chemicals, machinery, energy imports, and once you start putting levies on those, you are also increasing input costs for your industries. So it's not that productive from a European perspective either. So inevitably, and particularly because the U.S. runs a surplus, hitting services will be next on the escalation ladder. But I think the initial preference will be a phased approach to goods tariffs by the EU, putting them on some $120 billion worth of U.S. exports to the EU annually, and see if that's sufficient to get the Trump administration to the table. If that doesn't work, then the EU will start moving towards hitting services.
So and effectively that anti-coercion instrument being the Trump card when it comes to Europe. Would you agree? And do you think that that's what President Trump sees as Europe's Trump card?
So there's a lot of speculation around the anti-coercion instrument. I think there is some willingness to put what has been dubbed the trade bazooka on the table and used as a threat. But that trade tool is by definition a tool of last resort. And unlike many other options available to EU policymakers, it requires a qualified majority support, by the 27 member states, and many of those countries remain reluctant to escalate it to that level. Once you identify coercion by the Trump administration, it's very hard to stick that genie back into the bottle, and you are decisively on an escalatory path. So if you want to hit services, there are a range of other tools that are available to the Commission, which are less escalatory and easier to use, such as the enforcement regulation, the international procurement instrument, and others. So I think the use of the so-called trade bazooka, the ACI, is a tool of last resort, but we could see other steps to restrict access to European procurement markets, to make licensing and operation more costly or difficult, to apply surcharges to using of bandwidth, etc., to hurt U.S. service providers.
Very clear outline there of what the path of options is before we get to that bazooka, as you said. Emre Pikar, thank you for joining me, Director of Europe at Eurasia Group. German coalition talks have reportedly been paused after 13 hours of negotiations. That's according to German public broadcaster Tagesschau. It had been expected that the CDU, CSU, and SPD could reach an agreement overnight, but parties are now said to be working toward an agreement by midday today, with talks scheduled to resume this morning. Italian Prime Minister Giorgia Meloni is set to meet U.S. President Donald Trump next week for an official working visit. Meloni will visit the White House on April 17th, the first European leader to meet with Trump since he announced 20% tariffs on goods from the EU last week. Coming up on the show, China's top leadership reportedly set for talks on how to boost the country's economy. We'll bring you the latest next.
You want to talk business? Meet me in the On-Board Lounge. I just took a shower above the clouds. You know why? Because this is the Emirates A380.
My desire to keep learning, that is what drives my ambition. I sought a career change after 5 years working in corporate law to pursue a passion, which is to tell people stories and help our audiences make sense of the world that we live in.
Welcome back. China's top leaders will reportedly discuss measures to boost the domestic economy after Trump's tariffs came into effect today. That's according to Reuters, which cited sources familiar with the matter, and said leaders will also consider how to stabilize markets in the wake of U.S. tariffs. We've seen some fascinating action in China's yuan. I want to call your attention. Overnight, we saw a sharp weakening in the offshore yuan. It's fallen to its lowest level in history against the dollar. The onshore yuan has also weakened to, I believe, a 19-month low. You're looking at your screens right there. The onshore trading around 7.34, offshore around 7.378 or so. A lot of questions now around whether we see a further devaluation in the yuan, which obviously carries risks for the domestic Chinese economy in terms of capital flows and also the stabilization of the economy in general, or how stable the economy could remain if we do see a devaluation. But that would obviously mark a major escalation in tensions with the U.S. So something to consider and watch over the coming days. Elsewhere in the region, U.S. officials say allies including Japan and South Korea will be given priority in trade talks. South Korea's trade minister is traveling to the U.S. after a call between President Trump and South Korea's acting president, Han Duck-soo, with Trump saying he's optimistic a deal can be reached covering trade and payments for the U.S. military presence in the country. Japanese negotiators are looking to begin talks with the U.S. administration in the coming days, with President Trump saying he would seek tailored deals. Looking at the Asian markets, the optimism that we saw yesterday has proven short-lived for Japanese markets. The Nikkei 225 pulling back nearly 4% in overnight trade. Over in the mainland, we are seeing further gains. However, Hang Seng and the Shanghai Composite up this morning. We do know Beijing has stepped in to support markets in the last couple of days, and that's providing some extra lift there. The Kospi in South Korea also trading lower in lockstep with Japan, down about 1.7%. Global travel stocks have been hit hard in recent trade with fears of a global slowdown hitting the demand outlook. Let's take a look at the airlines today and see where things stand. We are seeing heavy selling across Europe. And this morning, the airlines no exception. The IAG shares, British Airways owner, down about 3% right now. Air France down nearly 3% as well. Lufthansa and EasyJet also getting hit hard. Well, to talk through this sector in more detail, Alex Irving joins me now, head of European Transport Equity Research at Bernstein. Alex, thanks for joining me this morning. Let me kick off with a line from Larry Fink, the BlackRock CEO. Earlier this week, he was speaking, saying that one CEO specifically said the airline industry is a proverbial bird in a coal mine, a canary in the coal mine, and I was told that the canary is sick already. What are you seeing? What are you hearing from the companies in your coverage?
Yeah. So I think that quote is appropriate, that it's a bit of a canary in the coal mine. People want to go on holiday, but they only do so when they feel like they can afford it. We saw weakness in the US airline industry back in March with a number of profit warnings. So far, nothing across the airlines in our coverage in Europe, though we did see Virgin Atlantic talk about some weakening of demand in the press just the other week.
So Delta Airlines, as you just alluded, Delta was the one who came out several weeks ago and really sent worry through the market that they were seeing a downturn in demand, but it seemed like it was mainly domestic at that stage anyway. That was before the Trump tariffs hit the tape. What would an economic downturn mean for airlines? It sounds like you're not seeing any signs of that happening yet, any weakness yet, but what would it mean?
Not yet, but so a couple of things will happen in that scenario. Remember that airline fares are always a function of the supply and demand balance in the market. So demand weakening tends to hurt your fares reasonably quickly. And then you run on a single-digit EBIT margin that has a very large effect on the bottom line. Let's say you lose 2% off your fares, you can lose 25% off your EBIT as that translates through. Next thing airlines do is they tend to reduce capacity, if that happens, to try and shore up margins. You see some pressure on price, that would take capacity, i.e. the amount of flying down, and that would be them trying to defend their business in that environment.
And what about the reaction from business versus leisure travelers? Talk about the sequencing that typically happens in an economic downturn and whether history is a good indicator of what might happen this time around, given the drivers that are in place right now.
Yeah, two very different reactions from both parts of the market. On corporate, you'll tend to see discretionary travel cut. Right? Oh, I'm going to go and spend some time with the team. Maybe not. There's no budget for that anymore. I'm going to go on a sales trip. Okay, if you've got a full schedule, fine. If you've got one or two meetings, you're going to do that via Zoom. Leisure, a little bit different. I think in leisure, what you'll tend to see is maybe a bit of down trading. People won't necessarily sacrifice their holiday, but maybe, let's say here in Europe, you're going to go to Spain rather than Thailand to spend a week on the beach.
Interesting. Okay. And I think very relatable probably for many. What about the transatlantic routes? I had a conversation several weeks back with a Canadian airline, and he told us that he was already, in response to Trump U.S.-China relations souring, he was already seeing Canadian travelers change their minds about traveling to the U.S. and opt for destinations like Puerto Rico, Dominican Republic instead of Florida. What about transatlantic routes? Are you hearing murmurs of travelers opting against traveling to the U.S. from Europe and vice versa, given what's happening geopolitically?
So far, more the vice versa. So the Virgin Atlantic CEO was out in the press the other week saying that they had seen a weakening of eastbound demand, so U.S. travelers traveling to Europe. And Virgin Atlantic is very, very heavily skewed to transatlantic. Sort of 70, 80% of their flying is that. We've not had any of the other European carriers similarly caution yet, though Delta reports pre-market today, and they are in a joint venture with Virgin Atlantic on the North Atlantic. So we'll know more in a few hours' time.
Interesting. So this is U.S. travelers pulling back on their trips to Europe, not vice versa. There's no sign of sort of anti-U.S. or backlash against the U.S. coming from the Europeans at this stage.
Nothing we've heard from the airlines yet.
Let me ask you about travel to Asia, sort of unrelated to what's happening on the tariff front, but there's been amazing competition come up in the last several years from airlines that fly through hubs like Dubai, like Singapore. How has that impacted the European airlines, which offer oftentimes direct flights to Asia, but potentially at higher costs than some of these other carriers?
Yeah, and it's got a lot worse, the European carriers, because now you can't fly over Russia. Flying over Russia is a faster way to Asia. It's more direct. You burn less fuel. You have lower time in the air. You're paying crew for fewer hours and so on and so on. You've got better asset productivity. With Russian airspace closed for the European airlines, you've got to go around. You're pretty much flying over the same sorts of airspace as Emirates, Qatar, to a lesser extent Etihad. So European airlines have found themselves at a relative competitive disadvantage since 2022. As a consequence, we have seen European airlines pivot their networks away from Asia, where the profitability has been poorer, and towards North America in particular.
Interesting. The closure of Russian airspace has certainly made flights longer. We went to Japan last year, and it was quite a flight. I think it was added 4 hours to the route that you would normally take pre the invasion of Ukraine. Alex, as viewers prepare, hopefully some of our viewers prepare for their summer travel, what's your outlook for pricing in Europe this summer, given all that's going on?
So pricing will vary airline by airline. I still expect some capacity growth a little ahead of GDP, and normally that tends to mean a bit of pressure on pricing. Some airlines have soft comps, notably Ryanair this summer, because they had a bit of distribution disruption last summer. I think they can maybe see a mid-single-digit price growth. The others not as strong. Some will likely see a little bit of pressure on fares, but still substantially more expensive than it was pre-pandemic. What's really important here is that there are fewer, that the fleet in Europe has undergrown demand over the last 5 or 6 years. There's just about as many planes in the sky in Europe as there were 5 years ago. Demand has grown. As we talked about before, supply-demand balance. Demand's outgrowing supply. You're paying more for your holiday than you were at the end of the 2010s.
Very clear, and I think anyone who's been trying to book for summer holidays would say that they're seeing exactly that play out. Alex, thanks for the insight. We'll keep an eye on Delta later today. Alex Irving, head of European Transport Equity Research at Bernstein. Coming up on the show, we'll be speaking to Jonathan Pingle, chief U.S. economist at UBS, to discuss the outlook for the U.S. economy as President Trump's tariffs roil global bond markets. That conversation up next.
CNBC. Live ambitiously.
So we have been here for the last 90 years. And because of that, it's so important. We have a long-term brand building goal and journey. Short-term marketing effort, short-term KPI is critical because these are the building blocks. By validating a lot of the activities through engaging our customers, through discussing with them their needs, understanding what we want to do, eventually we add them together. That is our long-term brand strategy. Banking is a people business, and that's why we need to enable and trust our team, our teammates to work, so that they know very clear strategic direction from the head office, from the seniors, and we lead by example.
I see ambition as enriching your entire life, your financial life, your personal life, and the lives of people around you, your community. My ambition is to build people up.
Frank Holland, Worldwide Exchange, CNBC.
Welcome back to Street Signs. I'm Juliana Tattlebaum, and these are your headlines this morning. America implements its harshest tariff regime in over a century, imposing so-called reciprocal levies on dozens of countries, with China subject to a 104% duty. Trump says the U.S. is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
European equities follow Asia into the red, set to give up Tuesday's gains as the EU becomes subject to an additional 20% levy. Long-dated treasuries sell off with the 30-year yield briefly breaching the 5% level amid fears of higher inflation and a global downturn. And U.S. futures teetering around the flat line with the Dow called narrowly higher after another turbulent trading day on Wall Street. Well, we are now an hour and a half into the European trading session. We've got red arrows across the board in Europe, also in Asia. The U.S. markets were called higher early on in the futures markets, but now futures have turned negative in the U.S. as well. So the negative momentum that we've seen in Asia, in Europe this morning has filtered through to the U.S., and we're seeing a downturn in U.S. futures as well this morning. And perhaps that's why we're seeing even heavier selling in Europe. The fact that futures have turned negative, the Xetra DAX down more than 3% right now, the CAC 40 down 3%. So we have not only reversed yesterday's gains, but we've also lost more. So quite a downturn in sentiment in Europe. In terms of the sectors, no sector is trading higher this morning. These are the best performers, and the auto sector, the best performer of the bunch, is down 1.8%. Every sector besides autos is down more than 2%, just to capture the magnitude of the selling we're seeing here. The worst of the bunch, the sector laggards in Europe. You've got healthcare at the bottom of the bunch. The basket down more than 5%. Novartis shares down more than 7%, on track for the worst day since March 2020. Typically a defensive part of the market, not today, as investors there brace for Trump to come after the pharma sector next. Treasuries, a lot of what's happening in equity markets may be tied to what's happening in treasuries. We've seen an aggressive sell-off in treasuries over the last few days, in particular yesterday. Right now, the 30-year trading at 4.86% or so. We had breached the 5% mark at one point in recent trade. The 10-year trading around 4.37% at the moment. And here you go, U.S. futures right now, red across the board. The Dow now looking to drop about 400 points at the open. We were in the green at the start of this program, so things have taken a turn for the worse in the last 20 minutes or so. Now, as mentioned, long-dated U.S. Treasuries are in focus, continuing to sell off this morning with the 30-year yield breaching 5%. We're just below that level right now. Let's talk about what's going on in Treasury markets and in the U.S. economy overall with Jonathan Pingle, Chief U.S. Economist from UBS. Jonathan, thanks for being with us.
Thanks for having me.
Let me just hand it right over to you, because I think you're much better placed than I am to talk about what's going on in Treasury markets and how concerning it is. From what I'm reading this morning and over the last couple of days, there's some concern out there that investors are questioning the safe haven role of U.S. Treasuries and now thinking that the Fed might need to step in to stabilize markets. What do you think?
Yeah, I mean, I don't know if we're at the point we need the Fed to step in. I mean, obviously if there's a certain amount of disorderly moves or, whether it's capacity on broker-dealer balance sheets. I mean, we can remember the episode, at the start of COVID in March and April, where there really was sort of this forced one-way selling, no other side. They did have to step in. I don't know if we're there yet. But you do have this overlay also with some of the price action that we've seen in the dollar, what we've seen in equity markets. There could be some questioning of global investors on really whether or not they want to hold U.S. assets given what's unfolding in trade policy.
And that would have pretty profound impacts on markets and on the U.S. economy overall, if that's really where global investors stand.
Well, I don't think, to be honest, I don't think it's irrational for global investors to be fundamentally rethinking U.S. assets at the moment. I mean, the scope of the trade actions announced are enormous, right? I mean, just to phrase this, the U.S. imported $3.2 trillion of goods in 2024. That's the size of the French economy. It's actually a little larger. It's almost the size of the UK economy. And we've decided to raise the taxes on that more than eightfold, right? So 2.5% tax, roughly 20, higher if you add in the reciprocal China tariff. So, I mean, there's a fundamental reordering of global trade underway here if these tariffs stay in place. So I'm not surprised that global investors are starting to get their arms around this decoupling.
Are you in the recession camp? Do you think that the U.S. is headed for a recession, or potentially in the Larry Fink camp where we might be in a recession already?
I don't think we're in a recession already. I mean, the incoming data through March is okay. I mean, we'll see how we go through April and May, I think. But I do think the second half of this year is going to be very weak. I did mark down our forecast such that we had back-to-back quarters of negative GDP growth. So I do think what we put in the forecast would count as a recession. Now, I did not put in a deep recession, but certainly there are substantial risks. We've never run this kind of experiment before in a contemporary, really import-heavy economy. So, yeah, we'll see. There's a lot of risks out there, though.
When it comes to the costs of these tariffs, I think it's pretty clear that the tariffs will lead to higher costs, even if you are in the camp that believes in the merit behind Trump's agenda to shift manufacturing back to the U.S. And believe in his agenda. There are going to be costs associated with these tariffs. Who's going to absorb those costs in your view? How do you see it playing out?
I mean, in our view, really everybody is going to have some pain here. The exporters, the importers. But I mean, we marked up our inflation forecast for U.S. consumers this year by almost 2 percentage points. So we're going to make the entire U.S. essentially poorer in some sense because in real terms, everything's going to be depreciated. But when I think about what's happening here, I mean, just the scale is just so large. The risks are everywhere. I don't think anybody's really going to be completely unscathed. And I just sort of wrote in my note Friday, this isn't really a comment on what the world looks like in 5 years or the potential benefits to U.S. manufacturing and jobs. Right? I mean, I'm not, we're not making a comment that this is just, long run negative. It's just that, in the short run, this is a monumental change to do quickly. I mean, it took us 40 years to build up these trading relationships since we started importing cars from Japan. And this looks like we're going to take our imports down to levels not seen since before that, right? Undoing 40 years could hurt.
And you don't know, and when you think about the medium to long term, you don't know what the consequences are going to be. For example, that China's currency has devalued. They've allowed their currency to weaken overnight, and there's a possibility that they allow it to weaken even further. How do you think about the dollar's role here, and where do you see the dollar going? How do you work that into your forecasts?
Well, the dollar matters. I mean, normally when you're doing a U.S. forecast, you actually don't pay much attention to the dollar because, if you look at the history of U.S. exports the last 20 years, but the problem is we're entering a regime where the last 20 years may not be a good guide to the next 20. So I don't have a great answer for that, but I will say there's one thing that's been really interesting. All the models kept saying, the tariffs would be dollar positive, and that was not the initial reaction. And I think that goes to this, sort of negative growth shock, negative outlook for the U.S., where it's not all about sort of, the relative price differentials of the tariffs. Some of this is a fundamental rethink of, do we want, capital flows going into the U.S.? And I think global investors are reassessing how much they really want to be putting money in the U.S.
There's been so much focus on the growth piece here. And you talked about raising your inflation expectations, but there's been so much focus on the negative growth hit with investors pretty quick to price in more cuts from the Fed. There's even talk of an emergency cut from the Federal Reserve now, given what's happening in bond markets. Do you think that's misplaced, that the Fed is not going to, what position do you think the Fed is in right now, given the inflation risks that you foresee?
Yeah, I mean, I think the Fed's stuck near term, right? So I think that the looming potential inflation lift, which creates such uncertainty, is going to make it very difficult for them to, sort of bail out financial markets at this point. But I do think eventually, if there are very real cracks in the labor market, that they will, to some extent, come to the rescue. I don't think they're itching to bail out Wall Street unless they really have to, unless it gets disorderly. But I think at some point, if this really is negatively affecting jobs, households, I think the Fed probably would step in at that point.
Let's come to inflation, specifically where we're going to see it show up and when. Where are we likely to see higher prices first, and when do you anticipate that starting to come through?
Well, I think we're already seeing little little bits of it. I mean, we're expecting a pretty soft print for CPI this month. But this is going to mount. We will see more of it in April, more of it in May. It's going to be concentrated in goods. It'll be concentrated in the tradable goods sectors. You can imagine it in autos. But we really think by the time we're in summer and going into the second half of the year, we will be seeing very rapid pass-through of these price increases.
How do we get out of it? If we end up in this situation where prices are rising, growth's taking a hit, is a tax package going to be enough to turn it around?
Well, you know, if I look at what the Senate and the House are discussing, they're not really talking about really boomy fiscal stimulus. I mean, you know, the Senate sort of settled on net $1.5 trillion in tax cuts. You know, the House wants to offset a lot of that with spending cuts. So that's not really of the scale we're talking about relative to these trade actions. So maybe, but they're not. That's not the conversation currently being had on Capitol Hill.
So how do we get out of it?
Well, I mean, you know, if I look at my crystal ball, if we don't walk back the tariffs, we're going to eventually settle at a new, lower equilibrium compared to where we were, where growth is a little, you know, the level of economic activity is going to be a little lower than where it was otherwise. I mean, the economy will eventually resume growth, right? I'm not saying this is going to be like permanently negative growth, but it's a shock. I mean, after we absorb the shock, the economy will resume growth, but it looks to me like it's a big shock.
All right. Jonathan, appreciate you stopping by. Great to have you in town. Jonathan Pingle, Chief U.S. Economist from UBS.
Thank you.
Tesla CEO Elon Musk has clashed with top White House trade advisor Peter Navarro in a rift which went public over the weekend when Musk posted on X that a PhD in economics from Harvard is a bad thing, not a good thing, seemingly referencing Navarro's degree. Navarro then drew the ire of Musk with his characterization of Tesla in an interview with CNBC on Monday.
Elon Musk and his Doge team is making a contribution to America in terms of waste, fraud, and abuse, and that's a very good thing for this country and the American people. When it comes to tariffs and trade, we all understand in the White House, and the American people understand, that Elon's a car manufacturer, but he's not a car manufacturer, he's a car assembler.
Musk hit back Tuesday, calling Trump's top trade advisor a moron and dumber than a sack of bricks before apologizing to bricks. White House Press Secretary Caroline Leavitt brushed off the rift.
These are obviously two individuals who have very different views on trade and on tariffs. Boys will be boys, and we will let their public sparring continue. And you guys should all be very grateful that we have the most transparent administration in history. And I think it also speaks to the president's willingness to hear from all sides, that he has people at the highest levels of this government in this White House who have very diverse opinions on very diverse issues.
Coming up on the show, Bitcoin slides as investors move away from risky assets amid fears of an escalating trade war. We're live at Paris Blockchain Week next.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
In addition to hedge funds and registered advisors, Interactive Brokers also serves individual investors. We give you all the tools and technology we built for our institutional clients for free. Let Interactive Brokers assist you with your market goals. The best informed investors choose Interactive Brokers.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange, CNBC.
Welcome back. Apple was the world's most valuable company in terms of market cap, but President Trump's tariffs have taken a bite out of the tech giant, allowing Microsoft to reclaim the title. Apple has had its worst four-day stretch since 2000 after President Trump's big tariff reset, with the stock plunging 23%. The iPhone maker was hit particularly hard because of its reliance on China for production. The company is now more than 33% off its 52-week high. It hit the day after Christmas. Let's take a look at crypto markets. We are looking at Bitcoin trading slightly higher this morning by about 18 basis points. But for the year, Bitcoin down about 17%. So it hasn't escaped the selling that we've seen in broader markets. Let's get out to Arjun, who joins us now from the Paris Blockchain Week event. Arjun, talk us through what's been happening in crypto.
Yeah, well, Bitcoin's kind of been hit with somewhat of a double whammy of factors here. The Trump and tariffs really have impacted the more recent market moves to the downside. Bitcoin sitting around $76,000, well off the $100,000 all-time high it hit a few months ago. But there was selling pressure on it before that, because the way Bitcoin got to that all-time high was very much a Trump-induced rally. The market very excited about a pro-crypto president, a pro-crypto White House, and potentially a pro-crypto America as well. But there has been somewhat of disappointment around the lack of policy so far, and around that Bitcoin strategic reserve, which also bought some of the air out the market at this point. So how's the industry feeling now? And really, what's their view on where the market's going next? These are some of the conversation I had here at Paris Blockchain Week as part of a series of recordings for my Beyond the Valley podcast. And I started with Monica Long, the president of Ripple, to get her take. Let's listen in.
Certainly, the macro environment has become very volatile, like you're explaining, and uncertain. And so I think we at Ripple, we in the industry, we are kind of watching to see what happens, how this plays out. Within crypto, I can say that, within the microcosm of crypto, there's been a lot of market volatility since the beginning. So high times, low times, long low times, the winters as we call them in crypto. And the technology is here to stay. And so especially at Ripple, like, we really take the long view of build. Like, if we build things that solve problems and there's really utility behind it, then, everything else kind of sorts itself out.
Yeah. Are there any risks at the moment that you see that may spark another crypto winter, or do you think the industry is on a lot more solid footing than it was when we saw the sort of last downturn?
Yeah, it's a good question. Crypto certainly exists within the macro economy, so it's I don't think it's it will be a part of the bigger picture. However that pans out, we're going to see. But in terms of like any specific risks to the crypto ecosystem, we're in a sturdier place. Like, if I think about the triple S crisis, the crisis from a couple years ago with the banks, Signature and Silvergate Bank kind of debanking crypto, that was a real systemic risk. It was very fragile.
Crypto's been historically very volatile, and people who have been in the industry for a long time, like Monica Long, say we've seen this story before. But the question is, are we in a prolonged period of downturn right now? This is a discussion I had with Charles Hoskinson. He's the founder of IOHK and the Cardano blockchain, as well as the co-founder of Ethereum. Let's listen in to what he had to say.
What ends up happening is crypto benefits in the long term, because geopolitically what's happening is we're moving from a rules-based international order to a great powers conflict. Now, we're kind of young, so we spent our entire adult lives under a rules-based international order, but our parents and grandparents, they lived under great powers conflict. It was the United States and the Soviet Union going at it. So it didn't matter what the trade deal was. It didn't matter what the rule law was. If the Soviet Union wanted to do something or U.S. wanted to do something, they just do it. And now we go back to great powers conflict. If Russia wants to invade Ukraine, it invades Ukraine. If China wants to invade Taiwan, it's going to do that. So treaties don't really work so well, and global business doesn't really work so well there. So your only option for globalization is crypto. If you want to do business with countries the United States doesn't like, or Russia doesn't like, or China doesn't like, in a global commons, you can no longer do that through treaty organizations or legacy banks and things. You can only do that through crypto.
Just to get back to kind of where we currently are, you don't think we're heading towards another crypto winter at all?
No. I think Bitcoin will be over 250,000 by the end of this year or next year.
What's going to drive that, do you think?
What'll happen is that the tariff stuff will be a dud, and then people will realize that the world is willing to negotiate, and it's really just U.S. versus China, and a lot of people will side with us, some people side with China. The markets will stabilize a little bit, and they'll get used to the new normal.
Just from these conversations, I'm getting the sense that the industry feels it's more resilient than before, that crypto could actually benefit from the turmoil. And part of the bullishness is the fact that there is still a government in the US now that is saying that it's pro-crypto, and that could support the industry going forward. More of these interviews will be published over the next 2 weeks as part of Beyond the Valley, so keep an eye out for those. For now, Juliana, back to you.
Our super interesting conversation, especially to hear him just say that, in his view, it really just boils down to the U.S. and China, all these tariffs that have come through in the last week. Arj, thanks for the coverage. Look forward to the Beyond the Valley podcast series. Let's get back to markets. U.S. futures have been bouncing around this morning. Investors seem quite unsure as to where to go next. You've got the Dow Jones now looking to drop about 140 points at the open. The NASDAQ in the green right now, so we bounce back into positive territory. The S&P looking to open just slightly lower. Alice Barr is in Washington with more on the fallout from President Trump's tariffs. Alice, good morning.
Good morning, Juliana. President Trump's trade war is dramatically ratcheting up as his unprecedented tariffs on imports from around the world took effect just after midnight, as you've been discussing. This has been spooking Wall Street investors once again. The president spoke at a Republican dinner last night and said that he knows what he's doing, that he believes that the overall impact for the economy is going to be legendary. In fact, he said that there's going to be more announcements shortly on pharmaceutical tariffs. The White House says 70 countries have already reached out to negotiate down these massive tariffs that just snapped into place just after midnight. And he says, the president says these countries are dying to make a deal. And that is something that Republicans are beginning to ask for, some of them at least, with some more urgency. We heard from Senator John Kennedy of Louisiana saying, pretty please with sugar on top, sit down with the countries that want to lower their trade barriers and make a deal. We've heard from several Republican senators that they think things will start to smooth out if there can be true signs that there are deals and negotiations coming. And we do know that South Korea's top trade official headed to Washington looking to try to reduce their tariffs. President Trump says that Japan is also sending a team for trade talks, so there are signs of some negotiations getting underway. But as you've also been discussing, China is really so much at the heart of what we're talking about here. And, there have been Republican senators also standing by the president, for instance, Tim Scott of South Carolina, saying that it's all an effort to recalibrate the entire global economy and bring manufacturing, everything back to America. But economists say it's going to take years to rebuild American manufacturing, especially for products like apparel, for electronics that long ago shifted overseas, and the U.S. is now especially reliant on China. With that cumulative 104% tariff and retaliatory tariffs coming back from China, we are going to see prices pressed up for consumers here in the U.S., and that's really putting the pressure on Republicans on Capitol Hill, on the Trump administration, though the president remains really steadfast in his approach, at least for now, Juliana.
Alice, thank you for bringing us up to speed with the latest. Back to markets. European equities under pretty severe selling pressure this morning. We have bounced off the lows. The Xetra DAX was down more than 3% about 20 minutes or so ago. We're now off 2.9%, but still pretty heavy, and we've reversed all the gains that we saw yesterday. The CAC 40 in France down 2.5%. The Italian market down 2.5% as well. So quite a broad-based sell-off in European equity markets. We also saw a sell-off overnight in Asia. Getting a check on treasuries, we are very closely watching the moves here. Aggressive selling in treasury markets over the last few days. Yesterday, we saw the 30-year cross the 5% mark. We're now trading around 4.814%. So we've come back down, but we had reached that 5% mark. The 10-year trading around 4.3%. A lot of questions around whether investors are reconsidering whether U.S. Treasuries are indeed the safe haven assets that they once were. There's also some debate swirling as to whether the Federal Reserve might need to step in and stabilize markets at some stage, whether the Fed might have to step in with an emergency rate cut. So a lot on the table when it comes to how the Fed and how the market may respond to this aggressive selling in Treasuries. As for U.S. equities, we've been hovering around the flat line, bouncing back and forth. Right now, the Nasdaq looking to open higher, the S&P looking to open flat, and the Dow Jones looking to pull back about 100 points. That is it for Street Signs. I'm Juliana Tattlebaum. The coverage continues with Worldwide Exchange next.
Our goal is to achieve 81% of electricity from a renewable source by 2030.
We have a tracking system more efficient because the panels are following the sun.
This area is protected as kind of an island for the biodiversity that surrounds the plant.
It's only by valuing our natural resources that we can truly move to a more sustainable future.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
This is CNBC on assignment at L'Oréal's US Research and Innovation Center.
Pledge is to invent the future of beauty, and therefore to do that you need the future of research centers, and that's exactly what's being built here, potentially the blueprint for our future R&D centers around the world, and it's going to serve the USA, our #1 market, but not only, because here will be invented new formulas that will serve consumers all around the world.
With a competitive beauty market constantly evolving, innovation is crucial to stay ahead. Consumers now seek products that cater to their unique skin tones, textures and concerns rather than one-size-fits-all solutions.
Personalization is definitely the future of beauty. Real personalization is also what I would call the ideal curation, is giving you the most precise recommendation of existing products, but which combination will be perfectly matching your needs, your skin tone or your hair type.
Leaders of business and tech talk AI. Name another industry that has a $10 trillion total addressable market. That's why everybody should be excited.
There's an accessibility to generative AI. It's unlike any technology that we've seen.
And its impact on the way we'll live and work.
To make sure that we are skilling up everyone is something we owe to society.
It's not AI or people. It's AI with people. And that will cause an economic boom.
Highlights from Converge Live only on CNBC.
There's a difference between ambition and greed. Greed is wanting more. Ambition is wanting better. And not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
It was a really good quarter.
This growth was driven by transactions.
Before they talked to Wall Street, they talked to John Ford and Morgan Brannan. Closing bell overtime.
Global stocks melt as President Trump's tariffs go into effect, including 104% on China. U.S. futures, they're a bit mixed, but honestly moving all over the place this morning. Right now, actually, they're higher across the board. See, for this critical day for the markets and for your money, we're going to start off with our top story. U.S. stock futures pointing to another volatile session with President Trump raising tariffs on China to now 104%. China this morning saying they'll be resolute and forceful in response. Custom tariffs on 86 other countries. They also go into effect today. Taking a look at futures, we mentioned they've been moving all over the place this morning. Just to be honest with you, right now the S&P up about 9 points. The Dow looks like it would open about 250 points higher. The NASDAQ also moving up over 100 points higher. So the president speaking last night, really remaining adamant about his tariff strategy and the fact that it's working. Also pushing back on Congress taking the lead in trade talks, despite bipartisan efforts in both houses of Congress.
I'm telling you, these countries are calling us up, kissing my They are dying to make a deal. Please, please, sir, make a deal. I'll do anything. I'll do anything, sir. And then I'll see some rebel Republican, some guy that wants to grandstand, say, I think that Congress should take over negotiations. Let me tell you, you don't negotiate like I negotiate.
All right. Again, that was the president last night. So today's action coming after another wild ride for stocks yesterday with the rally at the open, but then lower closes across the board. Take a look right here. So the S&P at its highs, it was up 4%. At its lows, down 3%. You can see here it closed down just over 1.5%. Similar story for the NASDAQ. Up over 4.5%, down as much as 3.5%, closing down more than 2%. The Dow, again, another multi-thousand point ride, up as much as over 1,400%, down as much as 800 points. You can see it closed 320 points lower right there. So this morning, the NASDAQ's more than 20% from its all-time high. The S&P, it's approaching bear market territory with its first close below 5,000 in over a year. Taking a look right now, you can see the S&P on the precipice of hitting bear market territory. This morning, we also want to look at Chinese stocks, of course, with the administration imposing 104% tariffs on Chinese imports. Taking a look, you're actually seeing Chinese equities higher for the most part. The MCHI that we track very often up almost 6%. Similar story for the FXI and also the KWIB, the Chinese Internet ETF. But down here, you can see the ETF that tracks all Chinese equities pulling back more than 1.5%. We're going to take a look at currency as well. The Chinese yuan also hitting its all-time low against the dollar. You see here, you're actually showing the dollar rising against the yuan. It's up about 1% over this week so far, week to date, I should say. We'll continue to watch the currency moves when we see, as we continue to talk about tariffs here. This morning, we also want to look at retailers and seeing how their stocks are moving following those import tariffs. Right now, taking a look, you're actually seeing retail stocks moving higher. Walmart shares up fractionally, Target shares up fractionally, Nike shares, very surprisingly, up over 2% higher in the pre-market despite its reliance on China and production there. Lululemon shares also up 1/3%. And we want to take a look at pharma. Last night, the president saying that tariffs for the pharma sector are coming. Taking a look at pharma stocks this morning, bit of a mixed picture. If you look at AbbVie up about 0.5%, but the rest of these stocks moving lower right now. Johnson & Johnson down 0.75%, Pfizer down more than 1%. Similar story when it comes to Merck. And we're going to look at the energy sector as well. Oil at a 3-year low at levels not seen since the pandemic. A lot of concerns about demand due to tariffs slowing down global economies. WTI crude right now down 3%. Similar story for Brent crude. Natural gas actually up almost 0.5% right now. And we're going to take a look at the bond market. A lot of action in the bond market. We're going to talk a lot about that just a short time later coming up in the show. Take a look at this. The benchmark at 4.33. Big upside move. A lot of concerns about economic growth here in the U.S. Broad sell-off when it comes to the bond market. Again, we're going to talk much more about this. Also, the long bond. It approached 5% yesterday. Remember, this is a read on inflation expectations. Okay, that is your setup now. We want to turn our attention over to the global markets. Red arrows all around the world as Europe opens another day deep in the red. Our Juliana Tattlebaum has the trade and a very unusual spot of green this morning. Juliana.
Frank, good morning. Well, let's kick off with Asian markets, where we did see stocks move lower in parts of the region. You had a pullback in the Japanese market. You can see here the Nikkei 225 lost nearly 4%. The Kospi, not on the board here, but the South Korean market also sold off, entering bear market territory. You do have a bit of green, though, in the Hong Kong market. The Hang Seng trading 0.7% higher, and the Shanghai Composite gaining about 1.3%. Why is that? Well, Beijing has stepped up its efforts to support the domestic Chinese Chinese economy and stepped up its efforts to support the market, and that's feeding through to the market action that we've seen overnight. Now in Europe, it is all red. Every sector trading sharply lower this morning. Every region is under heavy selling pressure. The Xetra DAX was down more than 3% at one stage. Now it's down about 2.7%. The CAC 40 in France down 2.4%. So reversing all of yesterday's gains. European markets closed up before the U.S. took a turn for the worse yesterday. So we actually closed higher, more than 2% for the Stock 600. But all of that has gone by the wayside today. In terms of sectors, you're seeing heavy selling in the healthcare space as pharma investors brace for those tariffs from the Trump administration. These are the best performers in the market, and the best performers are still in the red, but these are the worst ones. Healthcare down 4.5%, the worst of the bunch. Frank?
All right, Juliana, thank you very much. Our Juliana Teitelbaum live in London. We're going to turn our attention back to China. Markets there, you can see, they're actually holding firm in the face of new 104% tariffs from the U.S. Taking a look at some of the major markets right here. The CSI up just about 1% right now. The Shanghai Composite up over 1.33%, or right around 1.33%. The Shenzhen Composite up about 1.75%. Some of the biggest names in China also higher in the pre-market. We're going to take a look at those right now. You see Alibaba shares, they're up over 6.5%. JD.com up just about 6%. PDD up almost 3.5%. So this, as government officials meet this morning, also some new comments from President Xi Jinping. Our Eunice Yoon joins us now from Beijing with the very latest. Eunice.
Thanks, Frank. Well, in about 7 hours, the Chinese 34% additional retaliatory tariff is set to go into effect. And so far, it doesn't appear that there's any change of heart at all to call those off. In his first speech since the escalation, President Xi Jinping had painted himself as a defender of multilateralism. He said that he would pledge to strengthen ties with neighboring countries. The People's Daily, which is the voice of the Communist Party, also ran an editorial, an op-ed, where they quoted President Xi as saying that the best way to weather the storm is to focus with, quote, unwavering determination. Now, the Commerce Ministry today also has been arguing that China has abundant means to retaliate. At the same time, they said that the Chinese are open to negotiations. But a lot of the messaging, not only in official commentary, but also in the state media, has been that the method and the way and the conditions of these discussions are also very important. In fact, one of the social media accounts that is linked to state media, CCTV, and has been used as a messenger, I should say, for Beijing, said that we are willing to talk, but, quote, definitely not in the way the U.S. is doing. This is despite, Frank, the impact economically that this could have. A lot of the suppliers that we've been talking to here have said that they feel that at this level, that business is getting really, really, really difficult to do. And Capital Economics came up with an estimate saying that the exports to the U.S. will more than half, even if the renminbi weakens to 8 to the U.S. dollar.
So it seems like there's some conflicting messages coming out of China this morning. Willing to talk, but under these circumstances, the president's remained pretty adamant. The circumstances aren't changing. He wants to see negotiations. I'm curious about some of the communication inside of China right now. Is there any push by the local government to have people buy goods there in China or support local brands as opposed to U.S. brands?
Not specifically in terms of like a nationalism to not buy U.S. brands, but definitely there already has been a push to buy Chinese products, and that's been going on for quite some time. Also, a lot of officials are trying to get Chinese to buy goods more broadly, because that's also seen as one way to protect the country by relying more on consumption here in China.
All right, our Eunice Yoon live in Beijing. Eunice, always great to see you. Thank you very much. We're going to turn our attention back stateside now, and some of that whipsaw action for U.S. stock futures after the major indices that closed down for a fourth straight session. The S&P set to open up below 5,000 for the first time since April of last year. We've been all over the place this morning. You can kind of see the moves right here. Right now, the S&P futures essentially flat. So volatility, that remains elevated. The VIX, it's higher again this morning. Taking a look at the VIX, you can see it's at 48, just above 48 right now. But you're seeing the big spike right here. Tariffs obviously raising a lot of the anxiety on Wall Street. And just to show just how volatile things have been, since April the 2nd, the Dow's down almost 4,600 points from Wednesday's close. But if you take into account the whipsaw action that we've seen from day to day, session highs to session lows, especially in the last two sessions, take a look right here. The Dow has actually traveled more than 13,000 points. You're seeing Valleys right here. You're seeing peaks over here. You're seeing rallies here. So a lot of action when it comes to the Dow. So big question right now. What should investors be doing in this environment? Joining me right now is Rianne Mitrione, investment management partner at the Callan Family Office with about $4 billion under management. Also here with me is Victoria Green, G Square Private Wealth founding partner and chief investment officer. She's also a CNBC contributor. Ladies, good morning. It's great to have you here. Vicki, I'm going to begin with you. What should investors do? We're seeing so much headline risk, so much volatility in the markets. Is there any safe haven any longer?
I mean, the safe haven is short T-bills. That's about it. As we saw, the intermediate and long end certainly sold off hard and did not provide the haven people thought. And gold has also been a little more volatile. So if you want absolute security, you're going the 1 year and under T-bills, your money markets. But for me, it's don't panic. We want to look at this market and say, over time, buying bear markets, buying this volatility has been a great way to make money in the long term. So for me, it's don't panic. Don't knee-jerk panic sell. The world is probably not ending. It does feel really terrible to be a human being. We're getting so many mixed messages. We're having, 8% intraday moves the last 2 days. So be patient. Don't get tricked into thinking it. The last 2 days, we've had these kind of false rallies, right? That, oh my gosh, it's all in. We're going to have tariffs rolled back. I got to hop on board. So be a little bit patient. We're getting jerked around. We are holding right now, and we're buying very slowly. I don't think we've seen the bottom yet, but we're starting to buy some of these things that have sold off hard that we still think have value, have protective earnings, and really strong balance sheets to overcome volatility.
Yeah, I think everybody's kind of over trying to call a bottom at this point. Rianne, I'm going to come over to you. We had a lot of people come on our air and say when the tariffs were first announced, that board that a lot of people were making fun of now because of the formula, a lot of people said, well, this is worse than the worst case scenario. It seems like we've gone a well-traveled past that point. Right now, where can you put money to work outside of treasuries and short-term treasury? We had a number of people saying that. Is there anywhere to go in the equity market?
Absolutely. I mean, when we've seen a really substantial reset in valuations, in a really short amount of time. And so, if you've rebalanced, late last year, coming into this year and reduced some of those growth areas, now we've seen really significant pullbacks in technology and consumer discretionary, even in financials, in small caps. I mean, all of those now, especially, you look at small caps, they're trading, close to 30-year lows from a valuation perspective. It's, there are places that make sense to shift, rebalance back from, fixed income, which has had a positive return this year, and shift, incrementally into equities, just in standard rebalancing, buying into those hardest hit areas.
So, Rianne, I do have to ask you, I'm looking at the small caps right now. They're more than 25% off their 52-week high. They're obviously very economically sensitive to a potential U.S. slowdown or maybe even a recession. Why would you get into the small caps now with, I think, elevated recession risk?
It could take some time for this to play out, of course. And recession risk, our view is we're coming from a very strong place in the economy with where we are with these tariffs. If they stay in effect, we could easily see a mild recession, but we don't anticipate seeing anything too significant. And right now the market's hyper-focused on trade war risks. But when we move past that, we'll start to hear the narrative turn back towards deregulation and tax cuts, and that will all be supportive for small caps. But it's just hard when they're trading at levels like this. They are very attractive, okay. And that is one area where we still want to add.
All right, you're not the only person making that argument or has made that argument over the last year, but it seems like the thesis is unwinding a bit. Vicki, I'm going to come back over to you. You gave us some potential safe haven plays. Walmart and Costco. I want to ask you, you don't see China risk in those two stocks? I mean, we've had a lot of people come on and say, well, Walmart and Costco, they aren't that exposed, but they certainly do have some exposure. They also have exposure to consumer sentiment and economic slowdown.
Look, you're looking for an anchor to wayward and everything's on fire, right? We're the little dog with the mug saying everything is fine right now as the world's on fire. They are going to weather things better than most. You're still going to have to buy groceries. You're still going to have to buy clothes. You're still going to have to buy basic necessities. And I think both of those provide the most value and bang for their buck. And they have diversified their supply chains. Walmart does claim 2/3 of their goods that they sell are made, manufactured, or put together in the United States or grown. And so I look at Walmart, I look at Costco. There's very strong in grocery, which I think, again, provides them the defensive posturing because, yes, we are worried about consumer spending. We may not see the big ticket items fly off the shelves and televisions and electronics, but you still got to eat. You're still going to have to buy clothes if they're falling apart. And those two, for me, are best positioned. You are trying to find something that right now there's not a lot of safety. And so for me, those two provide what I think is a historically defensive posturing in an area that has to have spending in grocery.
All right, coming up later today, we get Delta earnings. We've already had a earnings warning from Ed Bash, and he's already warned about the consumer. What impact potentially do you see these earnings having on the market? And of course, you have banks coming up as well.
Yeah, I'm a little bearish on earnings coming into it. I think Delta is just going to rip the Band-Aid off and say, hey, we're really worried, and reset expectations and lower growth once again. I don't think that would surprise anybody. You know, I think nobody's going to care about Q1, honestly. We're all going to be hyper-focused on what's the outlook, what's the guidance, are we going to see it? And I'm a little bit worried that earnings are going to be, you know, we call it taking out the trash, that their stocks are down, so let's go ahead and reset expectations extremely lower so we can beat it down the road. I don't think airlines are going to have anything good to say. And Delta has a lot of international routes. They've got a lot to China and Europe. I see them a little bit more exposed there. They're my top pick in the airline sector. I just wouldn't touch them right now because they're very exposed to consumer spending and currency.
So, Rhian, I'm going to give you the last word. We have some economic reports coming up later this week. Probably most importantly, CPI. Is that still a market mover, or is it the president and tariffs that have control of the market?
I think the narrative right now is really focused on president and tariffs. The tariff narrative is so important. There will be some movement around CPI likely, but a lot of that is backward looking, and we're not seeing the effects of the tariffs really weighing in yet. So I think some of that may be just kind of glossed over, and it'll depend more on what's really going on with tariff negotiations. And hopefully, you know, I think the market is looking for a reason to rebound. So if we start to see some trade deals materialize, I think that would be a positive.
You know, to your point, we are seeing the futures higher right now. Rhian Mitrione and Victoria Green, great to have you both here. Thank you very much.
Thanks, Frank.
All right, we have a lot more to come here on Worldwide Exchange, including historic swings in the bond market and the urgent message my next guest has for Jay Powell and the Federal Reserve. Plus chips, pharma, lumber, and much more. President Trump, he repeats his willingness for more sector-specific tariffs. We're going to dig into one. And later, the rising cost of the president's tax agenda and some issues in Congress. A very busy hour still ahead when Worldwide Exchange returns. Stay with us.
CNBC. Live ambitiously.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
What inventions have transformed humanity?
The wheel, the light bulb, the internet, and me.
Learn how to use AI to be more successful with CNBC Make It's new online course.
It's about how we embrace the technology.
What we're really talking about.
Welcome back to Worldwide Exchange. Take a look at U.S. stock futures right now. You can see we're in the green across the board. The S&P up about 1/3%. The Dow up about 3/4%. Same for the NASDAQ. All right, turn our attention now to the Treasury market. Yields are spiking as investors, they may be selling on expectations of weaker foreign demand for U.S. bonds as tariffs take effect. The 10-year yield hitting 4.51% in the overnight session. That's the highest level since late February. The 30-year getting very close to 5%. Market watchers are speculating that hedge funds and not foreign buyers like China and Japan, they're largely behind the selling. There are two key auctions coming up as a test of demand, with the sale of $39 billion in 10-year notes today and $22 billion of 30-year bonds tomorrow. Joining me now is Gilbert Garcia, managing partner at Garcia, Hamilton & Associates. Gilbert, good morning. It's great to have you here.
Thank you for having me. Very exciting times.
All right, so let's start here. What's your take on the bond sell-off? Do you agree with the idea that it's hedge funds selling and that's what's leading to this bond sell-off, or are there other factors?
I think it's unclear, but I know one thing. Those that are selling are going to wish they did not, because we see the economy continuing to slow down with or without the tariffs. And we think that right now bond yields at 4+% are a bargain, especially for pension funds that are, of course, they finally have some yield in their fixed income. This is the place to be, U.S. Treasuries.
All right, so you think U.S. Treasuries are the place to be. We kind of teased you saying that you have a warning for Jay Powell and the Fed. What is that warning?
My warning is this. By the time you see the whites in the eyes, it's too late. The whole concept of being data dependent is too late. They should be cutting rates right now. It is clear that this is one of those events, and I've been around, I've seen the stock market crashes of the 80s, the dot-com, Lehman Brothers, COVID. This is another one of those things. They're going to call it the Trump trade wars. So this is the time to give confidence back into the market so things will settle down. They should cut rates now.
Oh, you think they should cut rates now? So in your mind, I just want to be clear. So you think that would...
Whether it's commercial real estate, whether it's a home mortgage, this is the time to be cutting rates and to get ahead of the curve.
By the way, you can't see us behind you. We're just showing some of the previous Federal Reserve emergency rate cuts. They were very big events. It wasn't necessarily the actions of a president, but we don't want to get too jammed up with that right there. I want to go back to where you see opportunities in the bond market right now outside of treasuries. What about municipals? A lot of people talking about municipal bonds. Also, we've had a number of guests come on and talk about high-yield corporate bonds. What's your take on those two?
I would not be buying high-yield corporate bonds at all. In fact, if you look, corporate bonds are still rich. What do I mean by that? If you look at the beginning of the year, high-yield, the corporate bond high-yield index was out-yielding about 230, somewhere in that range, and the high grade somewhere around 80 basis points. We've now widened. High grade is now somewhere around 125. That's still below the average, the 30-year average.
Okay.
If you look at high yield, it's now somewhere around just over 4%. That's also still below the average. There's a lot more room to go for those spreads to widen and those areas to underperform.
All right, municipal bonds. Is that safety? Is that the safe place to go?
That's a good place to go. And they now are attractive. For a while there, they had been overvalued, whether it's taxable versus tax exempt, or whether it's versus corporate bonds. But now they're very well valued. That's a good place to go, especially for individual investors.
All right, Gilbert Garcia, it is great to see you. Thanks for coming in the studio.
Thank you for having me.
All right, still on deck here on Worldwide Exchange, the role the bond market, speaking of the bond market, could play when it comes to the president's tax plan. Robert Frank, he's here to break it all down. Also, a historic slide for one Mag 7 member hit especially hard by President Trump's tariffs. We have the full details when Worldwide Exchange returns. We're obviously talking about Apple. Those shares actually up in the pre-market, up about 1 3/4%. Stay with us.
Apple, great company, is spending $500 billion because of tariffs. $500 billion, not 500 million. That's a lot. 500 million. You know, when I first heard the number, I said, you mean 500 million? You can build a lot of plants for... No, sir, 500 billion. 500 billion?
We're predicting good growth for tourism, so an increase by 6% in value to about £33.7 billion inbound spend this year. But the overriding challenge we have is that more than half of our visitors won't go outside London, but we want people to explore more of the country. We have launched our Star in Great Britain. That's a film and TV campaign. We use those stories that connect with people, the destinations that they see in their homes and they want to come and visit. And all around the country, we have different stories that we can tell that will encourage people to go out of London and explore more.
Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
If you're really ambitious, you don't think about the
Exchange. House Republicans, they're divided over a budget blueprint that would pave the way for Congress to pass President Trump's economic plan. Some lawmakers are opposed to the tax outline recently passed by the Senate because of its impact on the deficit. But there's an even bigger risk to the future of this bill. It's the bond market. Robert Frank joins us now with much more on this story. Robert, good morning.
Frank, great to see you. Well, the potential costs of the new tax bill have soared from about $4 trillion to over $8 trillion. Now, extending the 2017 tax cuts itself would cost about $4.5 to $5 trillion over the next 10 years. You add to that President Trump's new plan, so no taxes on Social Security, that's about $1.4 trillion. No taxes on overtime pay, about $900 billion. No taxes on tips, that's $100 to $500 billion. And of course, raising the SALT cap from $10,000 to $25,000, that could be billions more. You add all that up, and that could cost between $7 and $8 trillion. That money will not only raise the debt, but also the interest costs, of course, on the debt. So without an offset in cost, the Peterson Institute estimates that the interest on the debt plus the cost would raise the total to over $9 trillion. Now, to fund all that, the government will need to issue more debt, and that more supply could bring higher rates. You add to that, bond investors will demand higher yields for that added risk. The CBO estimates that every 1% increase in debt to GDP adds 2 basis points to long-term rates. So debt to GDP expected to rise by 34 percentage points over the next 10 years, given this scenario. So that would add 68 basis points in higher rates just from the tax change. Now, Frank, as you mentioned at the top, a lot of potential reasons for why yields could be rising here over the past 24 hours. Maybe it's foreign buyers, maybe it's hedge fund sellers. But I think taxes are certainly, as we see these bills proceed through the Senate and the House,
that the president may be open to raising taxes on the highest earners. How could that potentially impact just the view of the bond market for investors?
Well, it's certainly going to impact high earners, because remember in 2016, Trump said the same thing. Then we had the SALT cap, which hurt the high earners in the blue states. That was offset by those top rates coming down from 39.6 to 37%. If they raise that, that will really hit especially the high earners in blue states. But as we said at the top, they need some way to pay for at least offset some of these other tax cuts. So I'd say it's a real possibility.
You know, a lot of people in our audience and a lot of people you talk to on the Wealth Beat, they fall under that category of high-income earners. I'm just the messenger, everybody. I'm just the messenger. Hopefully they don't take it out on us. Robert Frank, it is always a pleasure to see you. Some very interesting reporting on the impact of the bond market on the tax plan. Thanks again. All right, as we head to break, watching shares of Apple after it fell to the second most valuable U.S. company yesterday behind Microsoft. Shares higher this morning, but coming off their worst three-day stretch in history, down 19% through Monday. And over the past 4 sessions, down 23%. That's Apple's worst 4-day stretch since all the way back in 2008 during the great financial crisis. Worldwide Exchange. We are back right after this.
CNBC. Live ambitiously.
Leaders from the world of sport talk tech.
You have technology that is now allowing coaches to reduce the risk of injury.
And new growth opportunities.
There's an opportunity for players to play across different platforms. I think that's really wonderful.
People like to lean forward and engage.
Only on CNBC.
Sponsored by
CNBC has the most affluent audience in television, and my job is to tell viewers how the wealthy make it, spend it, and give it away. I grew up in upstate New York. Both my parents were artists, so we didn't have money, but they taught me to appreciate beauty and also see things a little bit differently. For a lot of people, their ambition is to get wealthy. But money itself doesn't have any meaning. It's how you make it and what you do with it that gives it purpose.
The top fintech companies list is back. CNBC and Statista are looking for the world's standout firms, following in the footsteps of some of the biggest industry players. To find out more and submit your application, head over to cnbc.com.
It's very simple. We're making deals, and people are paying tariffs. Countries are paying tariffs. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
That was President Trump last night, remaining confident on the effectiveness of his global trade war. I see it right around the world this morning as those new tariffs take hold. However, U.S. futures pointing to another volatile day shaping up. You can see they're in the green right now. But to be honest, they've been moving all over the place this morning. Welcome back to Worldwide Exchange. I'm Frank Holland. Coming up this half an hour, much more, and another critical trading day taking shape. We also have former Commerce Secretary Carlos Gutierrez standing by, laying out what he calls the real consequences from these tariffs. And David Zervos from Jefferies, we're going to ask him if he's still optimistic on the Trump administration policies given the recent sell-off we've seen in the U.S. markets. But first, back to our top story. U.S. stock futures pointing to another very volatile session with President Trump raising tariffs on China to now 104%. China this morning saying it will be resolute and forceful in response. Custom tariffs on 86 other countries also go into effect today. Taking a look at the action, we mentioned in the green across the board, the Dow looks like it would open up about 200 points higher. The Nasdaq actually off of its highs of earlier today. Similar story for the S&P, pulling back just a few points. All right, this action coming after another wild ride for stocks yesterday with a rally at the open, then a lower close. You can just see the moves right here. S&P at its highs up over 4%, at its lows down 3%. Nasdaq at its highs up 4.5%, at its lows down 3.5%. The Dow, this is just, it's crazy. Dow up at its highs, up over 1,400 points. At its lows, down 800 points. You can see it closed down 320 points, really a roller coaster. So this morning, here's where we're at. The Nasdaq is more than 20% from its all-time high. The S&P, it is approaching bear market territory, also with its first close below 5,000 in a year. This morning, when I take a look at the S&P pre-market gainers, taking a look at those this morning, we're seeing Marsh & McLennan up here right at the top of the list. Those shares up over 17%. Caesars, Cummins, Alliant Energy, and West Pharma rounding out the best performers. Then the other side of the coin, the S&P pre-market laggards, taking a look at those this morning. Solventum, those shares over 5.5%, just a bit off of its highs of earlier. The FXI up just about 5.5%. The K-Web that tracks Chinese internet stocks also up nearly 6% right now. The Chinese yuan also hitting an all-time low against the dollar. We're going to show it to you here at kind of the inverse. The dollar rising against the yuan. A lot of worries about China devaluing its currency. You can see week to date, the dollar's risen about 1% against the yuan. We also want to look at the pharma sector after the president said that sector would face tariffs last night. Taking a look at those stocks this morning. These are treasuries. We're going to show you the pharma stocks in just a second, but we're going to move on, actually. We're going to move on to the Treasury market right now. Take a look at Treasury. We've seen a spike in Treasury yields. The benchmark right now at 4.36, a sell-off. A lot of people believe that could be hedge funds selling their treasuries to try to get some liquidity going. We've also seen the long bond. It just kind of touched 5%. Remember, this is a read on inflation expectations. And we want to take a look at the energy market right now. Oil at a 3-year low at levels not seen since the pandemic. You see WTI pulling back more than 3.5%. Similar story for Brent crude. Natural gas actually up off of its highs of earlier, but up about 0.25%. We had Vicki Green on the show earlier. She told me during the break that this may be on the idea that some of these Asian countries that are facing tariffs may try to buy some of our natural gas to try to reduce their trade deficit. We're going to continue to look at that throughout the show. And that's where actually we're going to leave this whole situation. That's your setup for this morning. Now, we're going to get back to our top story, more on the President Trump's, his trade war. We're going to bring in Carlos Gutierrez, former Commerce Secretary, former CEO of Kellogg's, and a CNBC contributor. Carlos, thank you so much for joining us once again. It seems like we're doing this every week, talking about tariffs and the impact on the economy and the market. You say there's some real consequences to these tariffs. Are you talking about the 104% tariffs on China, or is it just generally all the countries facing tariffs today?
Yeah, both. We are now, Frank, in a territory that no one expected. A few days ago, we thought we were looking at this analytically, but no one expected things to get this far. And the thing we have to realize is that it's not over. The president is doubling down. So as far as they've gotten, as dramatic as it's gotten, there's still more to come. We used to ask before, is this permanent or is this a negotiating tool? I think the real question is, how long will this last? Because it's all a matter of time. The president needs time to bring back manufacturing, to raise revenues, to do whatever it is he wants to do. But the more time goes by, the more damage will be done. So it really is, it's a contest of who gives in. Does time impact the economy to such a point where he has to give in, or does he continue to insist on bringing back manufacturing, on doing the things he wants to do in the time that will take? Well, it's interesting that the European Union offered zero tariffs, and very importantly within that was taking down tariffs to zero on automobiles. This has been a big issue for the U.S., especially coming out of Germany. As 10% coming out of the European Union, especially Germany, taking it down to zero. That's a big victory for the president. but he wasn't willing to take that.
Second. You're saying that's a big victory. You also came on our air and you said you believe these tariffs, they're going to be either reduced or taken away on the back end of the year. Do you still feel this way, that the tariffs are going to be short-lived? And then what happens if just the U.S. economy gives out first? What happens then?
Well, that's what I'm saying. This is a competition with time. The longer we wait, the more difficult the impacts will be. So I still believe that these tariffs will eventually come down. Maybe not all of them, but the trend will be downward. The point is, how long? When will that happen?
Okay.
Because we can't live with these tariffs, for a year, 2 years, whatever it is. It's a matter of time. But this is different than last week, Frank. What I'm saying today is the president is not done. It would be easy to say, I think he's gone far enough, and now he's going to start reducing. No. Everything indicates that he's going to keep going. Hey, look, again, the example of the European Union, it's a big win, but he's not taking it. He wants more.
Carlos, very quickly, I just want to point out to the audience, the S&P futures, they turn very fractionally lower right now before all the futures were in the green. I want to come back to you. Coming up later today, I know you're not a bond trader, but we have a bond auction later today. We have another one tomorrow. Is that something that potentially a Commerce Secretary, U.S. Trade Rep, the president himself may look at if we see less demand from foreign buyers? Is that something? If not, what is the president looking at? Because we're going to get some earnings later today from Delta. It's a very good chance they're going to signal the consumer is considerably weaker. We're going to hear from banks. There's a good chance we're going to hear that the economy is slowing down quite dramatically. What do you think this president would listen to?
Well, no question. All those things are going to be looked at, and the Treasury Secretary will be all over it. I think what the president is relying on right now, and the information that's giving him inertia, that's giving him motivation, is all of the calls he's getting from countries to negotiate. That tells him that this is working. So the numbers may be down in the short term. They may look a bit shaky, but in his point of view, this is working because everyone wants a deal. So he's got the upper hand. So right now, I don't think it'll be about the numbers. It's about how he's feeling, and he's feeling that he's in a strong position.
All right, Carlos, we got to leave the conversation there. It is great to see you. Thank you very much.
Thank you. Good to see you, Frank.
All right, coming up here on Worldwide Exchange, President Trump turning his attention to the world's largest chip maker, pushing to bring production to the U.S., plus pharma stocks pulling back as the president sets his sights on that sector. We're going to be right back. Stay with us.
The south of Spain has something truly special. We have over 3,000 hours of sunshine a year. Our government's goal is to achieve 81% of electricity from a renewable source by 2030. The Guiana cluster is the biggest total energy solar site in Europe.
We have a tracking system more efficient because the panels are following the sun.
We are giving access to more lower carbon energy, and at the same time we are respecting the balance of biodiversity.
This area is protected, so it can serve as kind of an island for the biodiversity that surrounds the plant.
This work is more than a job. Andalusia is about connection, sharing, and passion. This project is part of that spirit.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
I've always had an ambition to do something I loved. I actually got my degree in hotel and restaurant management, but I had a thing for numbers, and that's how I got onto Wall Street. I became a trader. I traded all different kinds of asset classes. The energy in a newsroom, when there's a big news day out there, feels a lot like the energy on a trading desk on Wall Street. There's a lot of activity. The stuff we do at CNBC means so much to so many people because it empowers you with knowledge and with everything that you need to make the right decisions.
Squawk on the Street, CNBC.
welcome back to Worldwide Exchange. Taking a look at U.S. futures right now. We've seen a bit of a shift right now. So the S&P now lower, down about 0.1% right now. The Dow also lower. Both of these were higher earlier, down about 1/3%. The Nasdaq still holding on in the green, up just about 1/3%. Stay with us.
The ultimate pre-market morning news show. Squawk Box, CNBC. Find your hustle. CNBC Make It's new online course, How to Start a Side Hustle. 3 industry experts break down proven paths to success and help you choose the one that fits your life. Go to cnbcmakeit.com/side hustle to register now.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
$19. They showed up right on time, did my dishes, my laundry, they even cleaned my windows. You just pick a date, pick a cleaner, and enjoy a spotless house for $19. I love using Home Aglow, and I think you will too.
I can feel the winds of change.
Empower. So handsome.
I can't buy this.
Whoa. Your Empower investment account has grown. You earned it. So get good at money so you can be a little bad. Empower.
If you're shopping for a home, you could browse hundreds of listings to find homes with big yards, or compare lot sizes all at once. Search in full color to find space to grow. Home search will never be the same again.
So which leg are we operating on?
Asking the right question can greatly impact your future.
Are you sure you're an orthopedist?
Especially when it comes to your finances.
Are you a certified financial planner? I'm a CFP professional.
CFP professionals are committed to acting in your best interest. That's why it's gotta be a CFP.
We're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here, and they're going to be opening up their plants all over the place in our country.
That was President Trump last night suggesting his long-promised tariffs on pharmaceuticals would be coming any day. A number of names in that space you can see right here in the red. Merck down about 1.25%, Pfizer down about 1.5%. Our Angelica Peebles has more on the challenges tariffs could present to the pharma sector.
Sweeping tariffs on pharmaceuticals could take away some of the complexity and mean that if the main ingredient of a drug is made overseas, that drug would be subject to a tariff. The U.S. imported about 1/3 of our prescription drugs, or $200 billion worth of medicine, in 2023. That's according to economists at ING Bank. Leering a price that's ultimately tariffed. On its own, a drug might only be worth the cost to make it, and that's much less than what drug makers charge for it. But with the IP factored in, it's valued much closer to the list price, and that would result in a far bigger hit to earnings, Reisinger says. But before we get there, the Trump administration needs to launch a Section 232 investigation. They would have to wrap that up within 270 days, but no one expects it to take that long. Until then, one lawyer tells me that companies are scrambling to sort through their supply chains, figure out what's made where and what the impact would be. But another says he doesn't expect to see companies make any meaningful changes to their supply chains anytime soon because there's just so much uncertainty that they don't want to make changes at this point. Frank.
All right, coming up on Worldwide Exchange, Jefferies chief market strategist David Zerbos. He's standing by on what's shaping up to be another volatile trading day. And the world's two biggest economies dig in further in the global trade war. We're going to be right back after this. Stay with us.
We can't predict when rates will drop, but while you wait, the perfect home is selling to someone.
6 a.m. Eastern, CNBC. The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan. Power Lunch, weekdays 2 Eastern, CNBC.
Every day, I'm reading extensively, I'm checking the markets throughout the trading session, working the phones, talking to sources, and doing my own reporting to share insights, information, and all of the details that you need to be able to make money.
Welcome back to Worldwide Exchange. Time now for a check of some big stories that we're following this morning. CNBC learning the Trump administration officials tasked with creating a strategic wealth fund are moving forward with its establishment. The president signing an executive order on the matter back in February, even suggesting it could buy TikTok. Meanwhile, the Trump administration is freezing more than $1 billion in funding for Cornell University and nearly $800 million for Northwestern. The White House says it's looking at both schools over allegations of civil rights violations. President Trump says he told Taiwan Semiconductor it could potentially pay a tax of up to 100% if the world's largest chip maker didn't build its plants in the U.S. Canada officially putting a 25% retaliatory tariff on U.S.-made autos. That goes into effect today. The move means that even if a vehicle made by GM, Ford, or Stellantis in the U.S. is compliant with USMCA trade, the USMCA trade agreement, parts that are not from Canada or from Mexico will be taxed. And a German regulator has ended its probe into Google and into its auto services unit, including Maps. This after the tech giant agreed to address Germany's competition concerns. All right, looking ahead to the trading day ahead as President Trump's reciprocal tariffs, they take effect, and China is releasing a white paper on U.S. trade and economic ties, Beijing reiterating it would take countermeasures on the 104% tariffs imposed by the president, but Chinese leaders say they're willing to communicate with Washington to resolve differences. Let's bring in David Zerbos, chief market strategist at Jefferies, also a CNBC contributor. David, good morning. Good to see you.
Good morning, Frank.
You're looking very calm. I don't think investors are calm this morning. A lot of swings in the futures. I mean, what are you seeing right now? What do you think about all this? You've been very, I'm going to call it bullish on the Trump administration policies. Are you maintaining that stance?
I am, and I think the strategy is been laid out fairly in a very straightforward manner. They want to end up in a cooperative place. They want lower tariffs all around. They want people to come to the table, and they are coming to the table. You have to threaten the sort of ugly outcome of being very uncooperative all around, and that gets people to the table. That's happening. Excited to see that happen in Japan quickly. Sounds like last night, as you reported, Frank, that the Chinese want to talk. That's actually a pretty big deal. I woke up to that one. The market doesn't seem to be as excited about that as I am, but we'll see how the day goes. Everything moves very quickly these days, so we'll see. Quickly. But I think I think we're going to end up in a more cooperative, fairer trading environment. The process to get there is threatening.
David, a more cooperative trading environment. You're talking about what the president's saying. Again, the president administration saying about 70 countries have come trying to negotiate. But what about what investors are saying in the equity market? Right now, we have the S&P approaching bear market territory and also the bond market. We've seen a broad sell-off there. What about what they're saying?
Well, you're not going to get a resetting of the global trading arrangement or a resetting of our fiscal policies and lower deficits and lower debt without some pain up front to get the gain in the future. That's the no pain, no gain strategy. Again, I think there's been a lot of clarity on that model that they're pushing. So, yes, that's a painful process to unwind mercantilism. And really, Frank, I want to say this because I think it's important, and I've been, kind of pushing this through my brain for the last few days. I really think the strategy here is to unwind decades of mercantilist behavior by our trading partners, whereby there's export subsidies, import blockages, accumulations of assets, and a vendor finance effectively of the U.S. consumer. And I think it's worked out for some big companies. It's worked out to get some cheap goods, but it's really
hollowed out the country and caused huge imbalances in financial markets through trade and budget deficits.
David, you're very focused on the potential of a long-term economic benefit, and clearly the administration is as well. But what about the short-term pain for investors? I mentioned some of the areas in near bear market territory, in correction, et cetera. But in general, sentiment is very low, and I think it's also low not only for the consumer, but for companies. CapEx spending is slowing down. Consumer spending is slowing down. How do the markets recover from that?
Look, this is tough, and there's a lot of ways it can go off the rails. It's not an obvious win, even in the long run. You could have this derail. So I'm not trying to be too Pollyannish here. I'm trying to explain where I think they're headed and why they're doing it. And I think it's a relatively admirable goal, but it's a difficult goal. It's like taking a patient off a drug that they've been on for decades. You've been on this drug of fiscal largesse. You've been on this drug of imbalanced trade that has benefited a few but hurt many. And I think it's tricky to pull that out of the system. They're doing it. And there's a lot of people screaming about it, which means it probably has been very imbalanced. But
David, let me bounce something off you because we're almost out of time. I want to bounce something off you. So we got some news right now about an Apple supplier called Luxshare. They're in talk. You already know about this. So they're in talks to possibly bring some of their operations outside of China, I guess, in response to these tariffs. So let's say we continue to see that. Countries coming to negotiate, companies themselves complying with what the president wants. Then where do you put money? What benefits? We often talk about the stock market being a long-term discounting mechanism of what's going on. Who's going to benefit and where does the money go in anticipation of that if you really believe that's going to work?
I think at the end of the day, you're still going to see returns on capital in the United States be some of the highest anywhere in the world. We are the place that treats capital the best. We have the best returns for human capital and physical capital on the planet. It's why we had the exceptionalism we did, and I don't buy that it's over. I think it's the end of mercantilism, not the end of exceptionalism.
One last quick question, David. We got to go. 10-year auction coming up. If we see fewer foreign buyers, does that shake up your view of all this?
It gets messy fast. Frank, that is really the linchpin. This is a trade war. And if countries can use their stock of U.S. financial assets that they've accumulated during this mercantilist activity, then they can create some problems. And
David,
we got to watch
go.
it.
It's great to see you as always. David Zervos from Jefferies, thank you very much.
Good to see you, Frank.
All right, I want to take one more look at U.S. stock futures. We mentioned all morning long, U.S. stock futures have moved quite a bit right now. Taking a look at the picture right now, we're seeing the NASDAQ still in the green, holding on to gains. The Dow looks like it would open about 200 points lower. The S&P fractionally lower right now. We were mentioning all morning long some of the movements when we were looking at retail and also stocks like Apple. Apple actually higher despite those 104% tariffs. That's going to do it for Worldwide Exchange. Squawk Box starts right now.
Good morning. Yep, some of those tariffs, the president's new tariffs took effect overnight, including duties of at least 104% on Chinese imports. China says its response will be resolute and effective. And in a speech last night, President Trump said countries are lining up to negotiate, and they're giving us everything we want. He said pharmaceuticals are next in line for new tariffs. Global markets reacting. European stocks are lower again. Treasury yields jumping. Markets here turned around and are now positive after they got up and said, oh, more of this. But by the time I got here, they're actually positive. Crude prices, though, tumbling back below 60. It's Wednesday, April 9th, 2025. Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin. Andrew's not live in Times Square. He's got some interesting stuff going on today, and we're going to talk about that in just a little bit. I like the sweater. I like the pocket square, Andrew. Let's take a look at U.S. equity futures at this hour because it's the first thing people want to do when they wake up lately. You never know what you're going to wake up and find.
Well, it's down again.
This morning, the Dow futures are off by 212
They were just
points.
up 200.
The S&P futures are off by 11. The NASDAQ is still indicated up by about 46 points. But blink and you could miss the direction at any point. Yesterday, I think there was a 6% swing for the S&P 500 between the highs and lows of the days. It actually ended down for the first time below 5,000 5,000 since April of last year. Comes after, again, those stocks reversed the early gains that we saw in yesterday's session. Ended the day down. The Dow was down by 320 points at the close, and the S&P closed down by more than 1.5%. The NASDAQ was down by more than 2%. Again, you don't know what you're going to get on any of these days. A lot of volatility.
Any of these hours.
Certainty. We have not heard from China yet, whether there would be a response or not. On Friday, remember, we heard at about 6:15 what their response was. They like to time things before the U.S. market opens, so we are on heightened alert for anything you might be hearing from China today. But take a look at Treasury yields, because this has been pretty confounding. Treasury yields have been climbing pretty rapidly. The 10-year is now sitting at 437. The 2-year is at 380. You've got the 30-year all the way up to 484. And there are a lot of reasons that people are citing for why treasuries might be climbing. One of them is it's the most liquid market. You may have hedge funds or other investors who need to sell what they can to pay off any potential margin calls that are coming. And that's where they might be selling things. Other questions that people have, though, is would China be reconsidering its purchases of treasuries? Other questions as to whether this is a safe flight. That prices have gone down as these yields have gone up, and there are a lot of questions about what this means. And there's a mixed picture in Asia overnight. Japan's Nikkei fell nearly 4%. Markets in Shanghai and Hong Kong rebounded slightly, and South Korea's Kospi was down by 1.75%. And then in Europe right now, where they are actively trading still, markets are in the red. The FTSE's off by about 2.7%. Other markets down by just over 3% for Germany, France, and Italy. And Andrew is joining us from a pretty special place this morning with some special guests who will be joining us as well, Andrew.
Thanks, Becky. We're going to be talking all about these tariffs and what it means for the markets. We're in Kiowa, South Carolina. This is the 4th annual gathering of a global sports Leaders Conference is hosted by Bruin Capital and Sportico, but so many of the folks who are involved in sports are right at the center of business, and we're going to have a bunch of huge exclusives with you, exclusive interviews this morning. We're going to talk to George Pine, who is the host at Bruin Capital later this hour. We're also going to be spending some time with Robinhood's CEO, Vlad Tenev, who's been outspoken about tariffs and has been seeing a lot of the flows with retail. We're going to show you an interview with former Secretary of State Anthony Blinken. It's his first TV interview since leaving office. He has sat across from President Xi. He has spent lots of time with our allies, including Japan, which, of course, is now at the front of the line to negotiate what these tariffs look like. And he's going to talk to us about what this all means and how it all could go in terms of gaming out these negotiations. And then we're going to speak with Apollo CEO Mark Rowan, perhaps one of the most influential people in the world of finance in terms of credit, private equity, and everything else. So we're going to get, I think, some real perspective. He, of course, was a supporter of President Trump's and has a lot of also provocative views on tariffs. I've gotten a whole lot of color even just down here. Ken Griffin from Citadel is on his way here. I ran into Mark Cuban, who is here. And then there's all sorts of other folks just in and about. A-Rod is at this conference. I spent some time last night with Adam Silver, of course, at the NBA. They have a huge presence in China. Ryan Reynolds, the actor and increasingly entrepreneur who has all sorts of business around the world. So these tariffs are front and center, and sports may be the topic, but really I think the topic is tariffs and to some degree soft power, by the way. We'll talk about that as well.
And Apollo shares have been one of the ones that have been hit pretty hard, down 18.5% just over the last 5 days. So he can talk to us about, what that whipsaw has been, too.
Absolutely. And I think we're going to have to get into, I think there's a larger conversation about the world of private credit, and a lot of folks concerned or questioning sort of what happens. Also, what does the Fed do in the face of all of this? Depending on where you think the equity markets go, and not just the equity markets, but can this spill over into other parts of the financial system?
Probably nothing unless something looks like it's starting to break in the financial workings.
Well, and that's the question, though. But do you and how much do you let it go? Would you let something break? Right.
Well,
that actually is a very fundamental question. All of this.
The Bank of England saying this morning that there are some hedge funds that are liquidating some things, some positions as a result, but they think everything's still moving in an orderly process at this point. But that's obviously the place that people are looking if there's any forced selling that leads to other financial contagion.
Yeah, well, at this point, it's on again, off again. Are we negotiating? Are we not negotiating? Yeah. And that spilled out into social media yesterday. Spectacularly, the two factions at the White House. You've got one who's an actual, I guess, someone that Trump could fire. You're talking about Navarro or Ron Vero, whatever you want to call him. And a lot of the comments he made the other day about Elon Musk not having a car company but a car assembler, that got Elon's dander up. So he was, you know, with his 204 million followers, that I was on the stupid train. So I'm still getting, I can't even open Twitter at this point. But the Wall Street Journal says, you know, they called it boys will be boys. They actually asked Carolyn Levitt about it yesterday. Carolyn Levitt said, yeah. But the Wall Street Journal said it's important to look at this because Trump is getting buffeted by the Navarro ultra MAGA crowd, almost neocon versus Elon Musk, who can't be fired at this point because he's not an employee. And the Journal is saying Musk is saying things that Trump needs to hear, that he's not hearing from. And so every time, you know, we had Washington Post, stocks jumped front page in the first hour of trading after Treasury Secretary Scott Bessent told CNBC that there were 70 countries negotiating. Right. Next thing you know, though, you get the China news, which is 500 billion that they export. That's a real, you know, that's not one of these small countries that we're doing a deal with out of the 70. That just like wipes all the good sentiment got wiped away immediately with 104% tariffs on China.
If you're talking about a trade war that is, that's an unretractable trade war once you ratchet things up, and that could be the path that we're headed on. Now, China has not said anything about this latest move to push those tariffs above 104%, but the day is young.
Well, how many great deals with the other 70 offset 104, something that it seems like it's not going to be settled anytime soon. And, you know, Trump likes to think that he's Machiavellian, and there's another piece that talks about what happens when people stop being afraid of Donald Trump. What if China, you know, calls his bluff and stays, even though they're going to have trouble because they do need the United States. But I don't think President Xi is a pushover, so I don't know how both sides save face here.
I think China just looks at things differently. It's not a party that needs to be reelected. It is not a party that's necessarily going to be concerned with short-term pain.
We've seen that,
they have a much longer term. They don't mind hurting their citizens for a longer period of time.
But let me just relay a conversation I had with one COO last night that does a whole lot of business in China and knows President Xi, and made one observation that surprised me, which is they're more patient, and because of that patience, actually, it's possible that they could, quote unquote, be willing to throw a bone to a President Trump, say, you know what, this guy's only here for 3 years. We'll give him something that he can have so he can look like he wins right now, and we'll get it back, and we'll get it back more down the line. Like that, I mean, that's one view of it. The other patient view is
the other idea of saving face. Yeah, and the idea of saving face. Both of these leaders don't want to look like they are stepping down and saying that they concede to the other, which is part of the issue too. Now, Donald Trump, in terms of what he thinks about this, he was speaking yesterday and said, "Hey, we're bringing $2 billion a day in these tariffs." So he's kind of trumpeting the idea that,
so to speak,
right.
But it's not from China, or it's from us. That's where the $2 billion is.
By the way,
that's where the $2 billion is coming from.
Us, and then also subtract 10% from the stock market and the trillions of dollars that have been lost in the past 2 weeks.
Nothing's been lost yet.
Those are paper losses, but it is a sign of confidence because everything runs on confidence, and it is a sign of lost confidence, and that's much harder to measure. I mean, all this money went to money heaven, I guess, but the loss of confidence, and that is a measure of loss of confidence, is pretty extreme, and you don't know exactly how that plays out from here.
We're going to talk about something we've been going back for. I can't believe, you know, there's a lot of things happening that I just think are beyond the pale. And if they let if they raise the top rate, when 95% of U.S. companies are not C Corp, they're pass-throughs, 95%. So only 5% do not pay at the personal or, use the corporate tax rate. And so if you raise that anyway, now he's saying that it's possible because he's got all these other crazy ideas that he sort of says off the cuff, tips, car loans, overtime, comes up with them on a plane ride, and he's going to go back on his 2017, the core of what happened in 2017. I don't know if he realizes it's pass-throughs, that it's 95% of small and medium, even large companies, some are not C Corp. President Trump speaking at the National Republican Congressional Committee dinner last night, just hours before his new tariffs took effect. Here's what he said about negotiating power with America's trading partners.
I do think that the war with the world, which is not a war at all, because they're all coming here. Japan is coming here as we speak. They're in a plane flying, lots of them, all tough negotiators. But things that people wouldn't have given us 2 years ago, wouldn't have even thought of it 2 years ago, 3 years ago, 5 years ago, 7, they're giving us everything.
Pharmaceuticals have so far been exempt from new tariffs, but President Trump said that will soon come to an end.
We're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here, and they're going to be opening up their plants all over the place in our country. We're going to be announcing that, so that's breaking news. Ladies and gentlemen, we have breaking news.
Global pharma stocks, take a quick look, and then we'll talk about what I was just talking about. Because Robert Frank, I was watching his report from earlier, we're talking about a huge tax bill coming up over time, which he's got some facts and figures about what it would add to interest rates, to give all those cuts. And Robert said it's being broached at the highest levels of the Trump administration, going back to 39.6 is being broached.
There are people who are, Republicans who had looked at this and said, okay, if you can raise taxes and pay down the deficit, that would be a different situation. But this is basically
they got to use the tariff money. They're supposed to use the tariff money to pay for all this stuff.
Well, they're going to use the tariff money to pay the farmers and others who are getting hurt by this, who are seeing the retaliation. So, there's only so much money to go around. There's only so many things you can do with it. And if you widen the deficit while you're doing all of this, then
you can get so populist that you turn a Republican into a Democrat. You can. And if that's what he thinks we elected, I'm not really sure that that's the case.
Well, there are also situations where Senators Elizabeth Warren and Senator Bernie Sanders have agreed with him on some of these things that he's doing. And we have Senator Warren joining us a little later today. She's not a fan of the tariffs and the way they're being implemented right now.
But
likes them used in targeted manners, not in these ways. But they do agree on some issues. Some of the things he's talked about. She's said in the past that she'd be with him 100% if he would cap what you can charge on credit card fees and other things along those lines.
Reading, I was trying to figure out how I was going to challenge her, and I can't believe I was nodding to what I was reading. It's a topsy-turvy world.
Anyway, joining us right now for a closer look at the markets is Ryan Dietrich. He is Chief Market Strategist of Carson Group. Ryan, your thoughts this morning as we watch these volatile markets. Would you step in at these points, or is the volatility so much that you're just kind of sitting back and waiting to see how this plays out?
Yeah, good morning, everyone, and thanks for having me back. And Joe, you and Senator Warren agreeing on things. I'm looking forward to watching that.
I know.
That'll be something.
I know. It's the antimatter meeting matter. The universe is supposed to end.
Yes.
Don't cross the streams.
Yeah. There's a lot of things going on, right? And I think to answer this question, what do we know, right? What do we know? We know more than 80% of the stocks in the S&P 500 just made a 20-day low. That is consistent with pretty close to major lows. We just saw that big spike up above 50. Once again, you're in the ballpark of lows. But you've had so many good guests talk about things. I think, what can I talk about that no one's really mentioned on the network yet? Here's something for you. Yesterday, the S&P was up 4% at the peak, closed down at least 1%. That's never happened in history, at least using intraday data back to 1978. But taking that one step further, 3 days in a row, the S&P 500 has closed at least 3% off the intraday high. So that's obviously weakness as the day goes on. We get it. 2 times in recent history we've seen that. July of 2003 and then August of 2015. Both of those times obviously were very volatile, but those were near major lows. And when you look at August of 2015, that was the low, right? We saw that 3 days in a row of weakness off the highs. Up 6% 2 days later, and then you're kind of off to the races. Now, I get it. There's lots of other stuff we can talk about, but I think to answer the question, we're in the ballpark here of hopefully some type of a pretty significant tactical low.
So you are buying at this point? Am I hearing that you're putting your money where your mouth is?
Mm-hmm. No, we're overweight equities, and we have been. Now, I get it. These last 11, 12 days have not been fun.
So you're praying.
So well, I don't know if we're praying. Let's say we're not praying, but I mean, yeah, exactly. We're still there. Now, one of the other things that's really fascinating, I know you've got some credit experts coming up later today, so I can't wait to hear those conversations. But when you look at high yield bonds, yes, they've been down a lot over the last week since obviously Liberation Day. But for the year, high yield bonds are still only down about 3.5%, with the S&P down 15%. I mean, we're still encouraged by the fact that they've hung in there.
That
Credit
the credit
spreads,
market hasn't collapsed, right?
It hasn't collapsed, exactly. And look, you look at credit spreads right now. Of course, they're higher the last 5 days.
Yeah.
But credit spreads, look at triple B spreads, high yield, all across the spectrum. Still not anywhere near what we were seeing in 22. Now, again, that can change quickly, but those are some little minor positives, I think, and a sea of negativity. And honestly, you look at the 10-year yield. I know you guys have talked about that before it came on, up over 450 when we all went to sleep last night, and you wake up and that's off of those highs. Is China dumping? Is it a global liquidity event? I mean, it's maybe a little bit of all those things. I'll tell you this, the yuan, it's not surging, right? I mean, so that it's actually lower. So that maybe means China's not just dumping like maybe zero.
Maybe they haven't completely manipulated the currency to this point.
Exactly.
But, look, I hear what you're saying, and I think a lot of people would like to hear that message of hope, particularly if they're long. What happens if China responds this morning and says that they are taking extraordinary measures? If it's not raising tariffs, maybe it's targeting American companies that are based there. There's a lot of things they could do to retaliate. If they do anything to ratchet things up, then what?
Yeah, it's probably more of the same what we've been seeing, right? The volatility, maybe late day weakness. Now, like you said, and we've been hearing 70 countries are talking to the White House. Maybe we get some other good news.
You could hear some good news.
You could hear some good news that maybe negates that. Now, one thing also is really interesting. We're really close to a bear market on a closing basis, as everyone knows, down 20% from the February 19th peak. I went back to World War II, 11 bear markets. If you simply looked at the S&P the day you move into a bear market, so we're not there yet, could happen today. 1 year later, the S&P is up a median of 23%. Only twice were you down a lot a year after you move into a bear market, 73, 74, and then the great financial crisis. So if you don't think we're in another situation like that, and honestly, we don't. We get it. Things are worse than they were. Right. But those are something to think about for those longer-term investors that, a month from now, who knows what's going to happen. But a year from now, we're optimistic. Go ahead, Joe.
Your poor clients still won't be back to even.
Well, it depends where you're invested, I guess, right? I mean, if you blindly look at that.
If you lose 20 and get back 23, you're not even.
If you start today, you're right. But I mean, we have been over at equities for a while, and I get what you're saying there. But we're also diversified. I mean, I get it. Bonds are up 1%.
If you start today, if you held at the top and it goes down 20 and then it goes back up 23, you're not even close to the whole.
Yeah, but again, well, that's true. But again,
unless you buy today,
cost averaging.
And we've been buying before today, I guess, is what I'm trying to say there. But I hear exactly what you're saying. That's why you're diversified. I mean, look at gold today. Gold's up 2% again, right? So there's still some things that are helping.
Throw some good money at bad, Ryan. Let's go. Let's get get going.
Hey, Ryan, thank you for joining us today. It is nice to hear a few positive thoughts on what's standing around us, but we appreciate it.
I appreciate it. Thank you, guys. Good morning. Thank you.
It's a Saturday Night Live thing, too. Wasn't it positive?
Oh, You're Beautiful? And
no, it was positive. No, it
Stuart, with Positive Thoughts with Stuart. What was the
Daily Affirmation. I don't.
Wait, it was the senator who did that.
Oh, on Saturday Night Live?
Yeah, it was Al.
Oh, my God.
Yeah.
That was before he was.
Al Franken.
Al Franken, right.
Yeah,
we got a lot more coming up.
Thanks,
a little bit of humor. I don't know, maybe a little humor. But President Trump and House Speaker Johnson whipping votes for the GOP's budget plan yesterday. Up next, Robert Frank's got a closer look at the rising costs of that bill that have got a lot of deficit hawks on the fence. They're a beautiful live shot of the Capitol this morning. And a programming note tomorrow at 8:30 a.m., a big exclusive interview, especially in this moment right now, with the CEO of Amazon, Andy Jassy.
I'm headed from Kiowa to Seattle right after this show to get to him. We're going to discuss the state of the consumer, the impact of tariffs, artificial intelligence, and so much more. Squawk Box coming right back.
This CNBC program is sponsored by Baird. Visit BairdDifference.com.
At Capital Group, we believe in the potential energy of fixed income. Fueled by 50 years of experience, our distinctive approach to fixed income investing has delivered strong long-term results and could power portfolios to reach investor goals. All you have to do to activate this potential energy is activate us. Capital Group Fixed Income. Actively different.
Boring. Certain you're on mute?
Yeah.
Are you for imprint certain?
Certainty matters. Experience certainty with 4imprint. High-quality promotional products, expert service, and on-time delivery. Visit 4imprint.com.
4imprint, for certain. After Homoglow cleaned our place for $19, we fired our old housekeeper. Homoglow tackled everything, from our kitchen to our bathroom, all our laundry. You just pick a date, pick a cleaner, and enjoy a spotless house for $19.
Your shipping manager left to find themselves, leaving you lost. You need to hire.
I need Indeed.
Indeed you do. Sponsored jobs on Indeed are 2.5 times faster to first hire. Visit Indeed.com/hire.
My husband, Dean, always worried that his diabetes would keep him from enjoying retirement. But Dexcom G7 has made it easy for Dean to manage his sugar levels and spend more time in range. We're feeling good about the future, wherever it takes us.
Welcome to Club Champion, and welcome to more gimmies, like gimme 20 more yards off the tee, and gimme more brands than any other fitter. Full bag fittings are just $100 with code PERFECTFIT at clubchampion.com.
I'm Dr. Shannon Klingman, the inventor of whole body deodorant like Mando. It's clinically proven to block odor all day and controls odor for 72 hours. Mando's unique formula stops odor before it starts. That's my secret to better odor control everywhere.
Some things are inevitable, inescapable, set in stone from the day we're born. And some aren't. Through Hims, you can get access to a range of options made with proven ingredients to stop hair loss and regrow hair. Formulas are personalized and prescribed by licensed medical providers 100% online. Break tradition with Hims. For regrowth in 3 to 6 months, get started today at hims.com.
The cost of President Trump's tax plan rising with every new proposal from Republican lawmakers. Robert Frank is going to tell us why the bond market may be the biggest risk to the president's tax bill.
Good morning, Joe. Well, the potential costs of the new tax bill, they are soaring from about $4 trillion to over $8 trillion. Extending the 2017 tax cuts would cost about $4.5 to $5 trillion, just that piece of it over the next 10 years. You add to that President Trump's new plan, so no tax on Social Security, that's $1.4 trillion. No taxes on overtime pay, that's about $900 billion. No taxes on tips, that could be anywhere from $100 to $500 billion. And then raising the SALT cap from $10,000 to $25,000, that's billions more. You add it all up, that would be about $7 to $8 trillion. And that money not only would raise the debt, but also the interest costs on that debt. So without an offset in cost, the Peterson Institute estimates that the interest on the debt would raise that total to over $9 trillion. Now, to fund all that, the government's going to need to issue more debt, and that more supply of debt could bring higher rates. More debt means bond investors will also demand higher yields to take that added risk. You boil it all down, the CBO estimates that every 1% increase in debt to GDP adds 2 basis points to long-term rates. So debt to GDP expected to rise 34 basis points over the next 10 years as a result of this tax plan. So that would add an implied 68 basis points in higher rates. We've seen these rates blow out over the past 24 hours. Some of that may be China selling, some of it may be the hedge funds. I think your point earlier is spot on. But I think also as the deficit hawks in the House are losing ground in this battle over reducing the cost of this tax plan, I think bond investors are also clearly paying attention to that.
I mean, that's the opposite of a virtuous cycle.
Yeah, because more debt, higher yields increases the cost of servicing that debt, and then it just starts to spiral. Exactly, that's what people are worried about.
So the thing that you hear President Trump or his acolytes, in terms of talking about the first term was the 2017 Tax Act. So one of the basic tenets, and we've talked about it before, that if you cut taxes, you're going to get more revenue from growth. That's the whole idea. So if you heard Trump himself say we might let the top rate go back to 39.6?
No, he said it, according to two reports now, at a meeting with Republicans. Lindsey Graham said, okay, you say everything's on the table. Would you consider raising rates on high earners? Not the wealthy, but high earners.
That'd be the
important
top
distinction.
1%, yeah.
And he apparently said, I'd consider that. I consider everything. Remember, in 2016 on the campaign trail, he said, I think we need to raise rates on the high earners. It's time. Remember, he said that. And remember, the 39.6 to 37 that was part of 2017, that only became because there was a big reception at Mar-a-Lago right after they announced SALT was going to be part of the plan. And all his New York friends were at that reception and say, you cannot do this without some kind of offset on top rates. So it was only because Gary Cohn, Larry Kudlow, other people around him said, if you're going to kill people with SALT, especially at the high end, you've got to have an offset. It was at the last minute they did that. I would not be surprised, given how politically popular it is to raise rates on the high earners. Plus, Trump and his friends, they don't pay ordinary income rates.
Right.
It's only chumps who pay ordinary income rates.
They've got all the partnerships.
So they've got the partnerships, they've got real estate depreciation, they've got all this fun stuff.
That's philosophically going against everything that they. That was the reason. The reason we're doing this is because it will generate more and it will cause growth.
Populist impulses are going against what traditional Republicans have done.
Exactly.
But more and more.
Andrew, yes.
I'm curious. We're going to have Elizabeth Warren on the broadcast a little bit later.
Yeah.
What do you think most Democrats think of this program? And not just Elizabeth Warren. Do you think the Democrats across the board would go along with it if there was no change in the SALT program?
I think there's a small faction of Democrats that are going to block anything that doesn't change SALT. Bringing it up to 25,000, I think, will appease most of them. But look, this is, as Becky just mentioned, this is a very populist tax plan. Tips, Social Security, overtime. These are, blue-collar workers. This is not a sort of job creation, job creator-focused tax plan that we are used to hearing from Republicans.
No.
And I think
you get populist enough, you turn into a Democrat. That's what you said. You do.
And remember, Biden's plan was saying we're going to extend all the tax cuts for anyone who earns less than $400,000.
Right.
Effectively, this is a redistribution that Trump is talking about from the top to the bottom. And I think a lot of Democrats would like it. They're not going to vote for it, but they're going to like it.
Robert, and they used to brag, and Trump has bragged repeatedly, everybody got a tax cut. Biggest tax cut in history. Everybody got a tax cut. But you have pointed out that because Willie Sutton, where the money is, a lot of the tax cuts did accrue to, they got, I guess, more because they're paying more. Some people don't pay anything, so it's hard to. But they'd go back on that completely and say, never mind. We didn't mean anything we said about trying to spur growth, and that's how we're going to deal with the deficit.
If you have to deal with I don't even know if you deal with the deficit.
Yeah, but they said it was growth.
For the rest, but if you pay for the rest of this, you have to go where the money is, too. And this is
But growth was going to be, that's all we have. We're no way we're tackling the deficit.
The top 10% pay vast majority of the tax, more than 3/4 of the taxes. So this will make it even more progressive if they raise the top rate.
But the tariffs are the opposite of that. The tariffs are basically
regressive.
Tax
it's the most regressive.
And hurt the people at the bottom.
They obviously didn't believe the story that they were telling us, that it's going to come back through growth, and the revenue that we're losing from the nominal rate is going to spur business activity and so never mind. We're going to go and do the pocket.
Again, I think that it could still do that. I mean, tariffs are a whole other issue. But on its own, I don't know that going from 37 to 39.6 will destroy
you know, A lot of the small corporate business- rate coming small down businesses. was good job. The corporate rate coming 95% are small businesses. immediate deduction of capital expenditures. Those are the things that really drove growth.
But you knew only 5% of companies are C corps of businesses.
So what you're saying is that
I'm just
small
saying
businesses are
will
going to
be
pay
affected.
that
They're
37 to
going to be
39.6.
They will small and medium. Even some large companies aren't C corp, and they pay at the level.
You're only C corp if you're issuing stock.
Right.
And
No,
you-
pass-throughs, LLCs,
and you got a lot of money for
partnerships.
accountants.
Those are the majority of taxpayers right now.
Robert, we wish you were here all day, every day.
Oh, that's Pink
literally,
Floyd.
this is amazing to have
Thank you.
your vast knowledge on these issues. We love having you here.
Thank you. Good to see you.
Another brick in the wall. Meantime,
Yeah,
we
wish
got
you
some
were
breaking
here.
news to bring you right now. I want to get straight over to Phil LeBeau because Delta Airlines just reporting, and he's got the numbers. Phil.
Andrew, take a look at shares of Delta. This is a beat on lowered guidance. Remember, the company warned about Q1 results last month. They cut their guidance. Well, they did beat on the renewed guidance, earning 46 cents a share versus the estimate. And again, remember, these have been brought down substantially over the last couple of months of 38 cents a share. Revenue coming in slightly below expectations at $2.98 billion. Q1 margin of 4.6%. The street was expecting 4.3%. Revenue per seat mile is down 2% compared to Q1 of last year. Free cash flow of $1.28 billion, below the $1.37 billion in the first quarter of last year. And here's the part that's going to be the reason you see shares of Delta under pressure. Delta is saying that the outlook, and these are their words, outlook says the growth has largely stalled. And that's reflected in the guidance for the second quarter and the rest of this year. Q2 EPS guidance of $1.70 to $2.30. The street going into this morning was at $2.30. Operating margin of 11 to 14%. The street was at 14.6%. Q2 revenue could be negative 2% to positive 2%. The street's expecting 1.9%. As you can see, everything is below what the street is expecting here. Second half capacity, flat is what Delta is expecting. Previously, it was planning on capacity growth of 3 to 4% in the second half of this year, and it is also pulling its guidance for the full year. I want you to think about this. Just a couple of months ago, we were here in Atlanta. We talked with Ed Bastian. He was forecasting record profits for 2025. Now they are pulling their guidance largely because of the uncertainty in the economy, what they are noticing with their forward bookings, what they're noticing in terms of demand going into the summer, both corporate as well as leisure. We'll talk with Ed Bastian about this, and more importantly, about what he's hearing from other CEOs, from other executives in terms of the economy. This is really our first snapshot of the consumer since the tariff trade wars really exploded a couple of weeks ago. That's coming up a little after 7 o'clock. Guys, back to you.
Hey, Phil, very quickly, watching the reaction in the stock, this is all bad news, worse than the street was expecting, but the street kind of knew that this was coming. These stocks have sold off pretty significantly. The last I saw, stock was indicated a little higher, 35.88. Okay, it's hard to say exactly where it's going to open. It closed at 35.88 yesterday.
100% right, Becky.
But these stocks have sold off because everybody knows that there's some big problems and that these are going to be the canary in the coal mine, I think, is what Larry Fink was saying, that he'd heard from a lot of these airlines. One of them described themselves as the canary in the coal mine, and the canary is sick. Stock market reaction for all of these stocks reflects that over the last week.
And it's not the numbers, certainly not the numbers for the first quarter, though that reflects the uncertainty that really kicked in the month of March. Right. But it's the guidance and it's the uncertainty. We'll talk to Ed Bastian about this. I've had discussions with Delta executives and other executives in other airlines. Everybody says the same thing. We cannot forecast an expectation of growth or limited growth given what we're seeing with booking trends. And so this is the first chance to hear from a CEO who can talk about that.
Phil, I'm confused on one component part of this is because we had a conversation, you and I and our audience, about a week and a half ago. We were talking about Canada, if you remember, and there were a whole bunch of numbers that we were talking about in terms of whether Canadians were still flying to the U.S., whether they weren't flying. There was a lot of speculation that they weren't going to be flying. I think some of the numbers that you had suggested actually that was not the case. Is that the case?
We'll find out when we talk with Ed. We'll get a more, granular view of what's happening with travel, Canada to the U.S., Mexico to the U.S. I can tell you that a couple of weeks ago, the industry, Andrew, and that's when we did that report, there had been all of these stories out that nobody from Canada is going to come to the United States. Well, the schedules that were put out, and that's what we based the report on, the capacity showed it was only a slight decline in the number of planned flights from January to March, and that's when you were looking at April and May bookings. That may have changed within the last few weeks, that you really start to see a drawdown in traffic. But we'll talk with him after the top of the hour about that.
Okay, we're going to look forward to that interview with Ed Bash and Phil. We're looking forward to you bringing us that, of course. Before we head to a break, though, take a quick look at the futures right now, because taking another leg down as we've been speaking this morning. The Dow now off about 433 points. The NASDAQ looking to open down about 42 points, and the S&P 500 looking to open off about 38 points. We got a lot more coming up on the broadcast, a huge number of interviews to try to explain what is going on around us. Squawk Box returns after this.
Interactive Brokers pays up to 3.83% on instantly available cash in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available cash in your brokerage account. The best informed investors choose Interactive Brokers.
Why do couples choose a Sleep Number smart bed?
Can it keep me warm when I'm cold?
Wait, no, I'm always hot.
Sleep Number does that.
Can I make my side softer?
Can I make my side firmer? Sleep Number does that. Your ideal firmness and effortless comfort all night.
Can it help us sleep better and better?
Please.
Sleep Number does that. 9 out of 10 couples report better sleep. Smart beds now start at $849. Shop a Sleep Number store near you.
Comcast Business doesn't just power businesses. We help turn them into logistics mastering, supply chain transforming, seamlessly restocking, frictionless paying, poke bowl ordering, cyber securing, mobile access granting, data managing. Welcome to the worlding modern businesses. Powering the engine of modern business, Comcast Business.
Introducing our icons, Peter Millar, luxury meets performance.
This is the story of the one who believes being prepared is not just a way of life, it's how he helps everyone stay safe. He sweats the small stuff before it becomes big stuff. For the one, being an unsung hero in a building full of everyday heroes is just how he likes it. The industrial-grade products you need delivered fast. Call, click Grainger.com or stop by. Grainger, for the ones who get it done.
Hi, I'm Jay Jackson. For almost 20 years, Abacus Life has been purchasing life insurance policies from seniors. And in just seconds, you can use the free calculator at abacuspays.com to learn what your policy might be worth.
For many of my clients, selling their life insurance to Abacus was right for them and their estate plan.
Don't sell or lapse your policy without going to abacuspays.com first. There are no fees and no obligations. Get the real value from your life insurance when you need it with Abacus.
Ready for whatever lies ahead, with confidence to navigate all conditions. T. Rowe Price actively managed ETFs, designed to outperform the index.
Coming up much more on the move lower, and it's gotten worse. Well, actually, it's gotten better and more. We were down over 450 a second ago, but now 340
again, because
where is it? It's got to be 50, I would think. As we head to break,
45.
I can tell you quickly. As we head to break, check out the market cap of Microsoft and Apple as of yesterday. Apple dip below Microsoft, giving up the crown as the most. They've been jockeying for the most.
Apple's had its biggest 4-day decline since 2008. Over the last 4 days, it was down 19% in 3 days. It was down again yesterday, and that was the biggest drop it's seen.
We could. This is like a basketball game. Leads change hands like 10 times, but the VIX is closed at 51.
Wow.
It's bidding 51, asking 52.40.
Wow.
Apple's pre-market gains, though, today bringing those companies back to neck and neck. Squawk Box will be right back.
Executive Edge is sponsored by AT&T Business. Next level moments need the next level network.
AT&T has a new guarantee because most things in business are not guaranteed. Like a distraction-free work environment. Get those steps in, Kevin. Your coworkers keeping things confidential? Oh, she's spilling all the tea. Or office etiquette. Yeah, that's not guaranteed.
I know you can see.
You know what AT&T guarantees? Connectivity you depend on, the deals you want, and the service you deserve.
Can I get that logo bigger?
Or we'll make it right. That's the AT&T guarantee.
Double check that. Pretty good. Yeesh. Not crying, are you? Let's tighten that. Ooh. Wait, what was that? What? No, don't worry about that. Here we go.
Asking the right question can greatly impact your future.
Are you qualified to do this? What?
Especially when it comes to your finances.
Do you have a question?
Are you a certified financial planner?
Yes, I'm a CFP professional.
CFP professionals are committed to acting in your best interest. That's why it's gotta be a CFP. Find your CFP professional at letsmakeaplan.org.
At Odyssey Trust, we're more than just a transfer agent. We're on a mission to deliver peace of mind by making things simple, fast, and easy. We're proud to be the trusted partner of over 1,000 clients in Canada and the United States.
Yo, I can guard pro in these.
I can guard you and route you up.
You sure about that?
You fellas looking for a quarterback?
The goal!
You're right, Billy.
These do bring out my eyes.
Every shoe for every athlete.
Dix is the GOAT.
You've got a glow about you, inside and out. Show it to the world with just 10 minutes of self-care. Meet Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com.
I find it challenging to come up with a gift that's really impactful, something that really makes a difference. Jolie has been a tremendous gift. It's something that is not only looks beautiful, but makes us feel amazing, and is something that we get to use every day.
All right, locked in for this meeting. Total focus. Double booked? All good. Otter AI gives meeting notes and insights, even on meetings I can't attend. Dang it, I picked the boring one.
Otter, the AI meeting agent.
Welcome back to Squawk Box. We are in Kiowa Island this morning. Sports leaders from around the globe all here. Joining us right now is the host of this year's event, George Pine, Bruin Capital founder and CEO, and it's great to see you. I want to talk sports, but the truth is I want to talk about tariffs, and I want to talk about sports in the context of soft power, because we were talking to Anthony Blinken last night, and we're going to have some of our interview on this broadcast a little bit later. But as you're thinking about tariffs, everybody here, that's all anybody wants to talk about. What does it mean to the sports business?
Well, instability and unpredictability is not good for any business. Sports is the same. So it's making it choppy. Sports is a consumer business, impacts consumers, impacts the whole industry. So everybody's on their toes right now.
And when you think about different leagues, I know Adam Silver is here. Obviously, they have a huge business in China. I mean, how much do you think about the international piece of the sports industry?
Well, we're in 24 countries, and we're sports exclusively, so we feel it a lot. People are asking us questions. We're answering questions we've never had before. There's a lot of uncertainty, particularly as an American-based company. So we're navigating things we haven't navigated before, but we're getting through them.
What about merch, right? I mean, a huge part of the sports industry is merch. You were the CFO of IMG back in the day. The merch was a huge piece of it. What is it? How do you see all this playing itself out?
Well, like everybody else, we're watching. We don't know. I mean, we own a simulator company. A lot of the parts come from around the world. Our prices are going up 40%. We have a company that lights the pitch around the world. have to import stuff to the U.S. We don't know what that means. So it creates a lot of uncertainty in the supply chains and in the ability to execute. And sports is no different.
What do you make of the branding issue, though? Which is to say, I think one of the things that I was talking to Blinken about was this concept of soft power that we have presented, whether it's basketball or baseball or football around the world. It's been a soft power, and that the rest of the world has loved America in large part because of our sports. Do you think that's changed?
Well, it's a lot in a short amount of time, but we're going against the backdrop of the FIFA Club World Championships this year, the World Cup next year, the Olympics in 2028. So all of that logistical planning is going on right now. So that's creating another layer of uncertainty. So that's a negative. The positive is, the sports has the potential of bringing people together, bringing the world together, and the world's coming together in 3 big events in the next 3 years.
A lot of sports, including college sports, is becoming privatized. And a lot of the folks, Apollo, we're going to talk to Mark Rowan here later. They're in obviously the world of private credit, but a lot of even the credit folks are now in sports. Everybody has gotten into sports, but what do you think all of this uncertainty does to valuations, does to the kind of deals that are in the mix right now? I know the Celtics deal just got done, sort of. It's not done. But how do you see all of that playing out?
Well, I think, sports has been very durable when you go through the economic crisis and other dot-com bubbles. Sports has held up real well, so I think that will remain the same, that it's a safe haven for investment. But, of course, investment's going to slow down as people retreat a bit. Sports will probably be impacted by that, but I don't think the valuations will change very much. And I think, again, when you're looking for a flight to safety, sports historically has been pretty safe.
What do you think about, so obviously there's the big NBA deals and the NFL deals and some the majors, right? And then there's all of these other sports that are emerging. And I'm not talking about just women's sports. I'm talking about, drone
sailing,
drone racing, all of this other stuff, because this is supposed to be what people want to watch live. It's the only thing that people want to watch live.
Right.
Do you think that those valuations hold up?
Well, if capital becomes constrained, new products, new offerings are going to be impacted. These early stage sports are no different than any other new business. So yes, if people pull back from investing, sports will be impacted to some degree, especially new and emerging sports.
What is the most interesting new sport that you're focused on?
I think I kind of like the sailing, to be honest with you. Those boats are pretty cool. It's global. I think it's very interesting.
George, thank you for having us. This is a great event that you put on, and it's unbelievable that you've been able to collect all of these different people from all sorts of walks of life.
Well, thank you for coming. So we love hosting you guys.
We appreciate it. Thank you very much. Becky, back to you.
Andrew, the conversation's fascinating, and the backdrop is beautiful with the sun coming up. Looks like
okay. It is. The sun is coming up. It's beautiful.
Don't worry. The sun's coming up no matter what the markets look like this morning. Anyway, when we come back, the IRS is about to lose its third chief since the start of the year. We've got the details on that next. Squawk Box, we'll be right back.
Franklin Templeton Custom Tax Management. Easily create custom SMAs with our Canvas platform and help investors keep more of what they earn. Franklin Templeton, your trusted partner for what's ahead.
As a business owner, I've got a lot on my plate. That's why I use ZipRecruiter to hire. ZipRecruiter has this feature called Zip Intro. I chose the time, and it did all of the work of finding and scheduling the candidates for me. I just picked my top choices and talked to great people the very next day. The plan was to hire 2 people, but the candidate quality was so good, I wound up hiring 4 in a week.
Zip Intro. Post jobs today, talk to qualified candidates tomorrow. Try it free only at ZipRecruiter.com/CNBC.
Zip Dish for Mary?
Didn't Zip Dish just have an earnings call? Wonder if their take rate finally improved.
Have a question about a stock? Just swipe down and ask. Alpha, AI for investors, only at public.com.
Oh, I hate these things.
Yeah, sometimes you just want a human.
Can we get a human over here?
That's one of the great things about Consumer Cellular. Their 100% U.S.-based customer service is also 100% human. You don't have to, you don't have to talk to a bunch of robots, just humans in America.
Robots are the worst.
Yeah, I think it's mad at us. For unlimited talk and text with reliable coverage and your second month free, call Consumer Cellular.
If you're looking for the one, find the home with a short commute to work.
Find the one in a great school district and find it exclusively in professionally sourced listings. Download the Realtor.com app today.
When I started Walton Goggins Goggle Glasses, I needed a website. And GoDaddy Aero uses AI to make a beautiful website so fast it'll blow my customers' noggins while they're shopping for Goggins for their noggins.
HomeAglow just cleaned my entire house for $19. Seriously, $19. They showed up right on time, did my dishes, my laundry, they even cleaned my windows. You just pick a date, pick a cleaner, and enjoy a spotless house for $19. I love using HomeAglow, and I think you will too.
I can feel the winds of change.
Frank Holland, Worldwide Exchange. Weekdays 5 a.m. Eastern, CNBC.
So many in this business try to scare you. We try to give you the confidence to do it yourself.
By joining the club, it gave me more confidence in my investing decisions.
There's just a huge reservoir of information available. You couldn't ask for more support.
It just is a game changer because you can feel confident through the highs and the lows.
The club creates confident investors no matter what the climate.
Get invested. Join the club today. Go to cnbc.com/join Jim.
Late last night, reports said that acting IRS Commissioner Melanie Krause is planning to resign. Multiple reports say that she has applied for a deferred resignation offer available to federal employees. That move comes after the agency struck a controversial deal to share tax data with the federal immigration authorities to help them locate undocumented immigrants. Krause will become the agency's third leader to exit since the start of the year. President Trump has nominated Billy Long to run the IRS, but he is still awaiting Senate confirmation. When we come back, former DOJ antitrust chief Jonathan Cantor will join us. And by the way, stock futures, they've been volatile over the last hour. Right now, the Dow futures are still down by about 160 points, not the 440.
S&P is surging.
We're looking at S&P is up by 1 point. The NASDAQ is indicated up by close to triple digits. Again, if you don't like what you're seeing, wait. It will change, just like the weather. It's been fast and frequent. Don't go anywhere, but we will. We'll be right back.
Can you see a picture yet?
Not yet.
Not yet! What about now?
What's that?
Just streaming the game.
Innovation changes everything.
Go left.
Go left.
Go left. Go left.
Go left!
Left!
With one investment, you can access the NASDAQ 100 innovators who are rethinking the world. Before investing, carefully read and consider fund investment objectives, risks, charges, expenses, and more in prospectus at Invesco.com.
I'm certain it's level 5.
Are you for imprint certain?
I'm certain it's level 5.
Certainty matters, like the certainty of 4imprint, your home for high-quality promotional gear, including exclusive items and brands they love, printed perfectly and guaranteed to arrive on time. To wow your clients, nail your next event, or inspire your team, check out 4imprint.com.
4imprint for certain.
What's the worst phone call an exec can get?
Reach. What?
Scott?
Harris?
Right now we are completely offline and there is a ransom.
How much? So how are you going to recover from that? What if you could instantly rewind back to before the attack? With Commvault, you can do it in just minutes.
Like it never happened.
It's the fastest, most complete recovery anywhere, so you can be a continuous business.
Okay, monthly sales meeting. Stay focused. You got this.
Hey, Julia, do you have the sales numbers?
Good thing Otter AI gets me answers quickly.
Otter, the AI meeting agent.
The only thing I don't like about payday is waiting for it. Chime lets you get up to $500 of your pay whenever you need it. There's no interest, no credit checks, no mandatory fees. I'm not waiting for payday anymore, and you shouldn't either. Join me at chime.com and get paid when you say.
This is the story of the one who doesn't just see a broken dock. He sees lost revenue, a late night, and work stalled to a halt. Thankfully, he has the experience to handle whatever comes his way and has Grainger on his side, offering access to technical product specialists and the scale to deliver fast, so he can keep his business in gear and always moving forward. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
Joining us now, former Assistant Attorney General Jonathan Kanter. He served as the DOJ's antitrust division chief in the Biden administration, which apparently is still in charge. He's now a CNBC. No, you say no. He's now a CNBC contributor. Antitrust, not much that we can tell. We don't know, but not much of a change so far, especially if J.D. Vance has his way. Thinking about raising marginal rates on top earners. And we've got blanket tariffs, Democrat tariffs around the world right now that they saw. So you must be happy.
Well, there's one key difference. That key difference is
people were doing well.
People were doing really well.
Yeah, from from running $2 trillion deficits when you didn't need to after the pandemic was already over. No one's income went, no one's wages went up because of inflation. It wasn't that great. Now we got the worst.
Would you rather have that economy or this economy?
This is a work in progress. It's not even 100 days yet, Jonathan. No, I've got my own problems. You can see I just said that. But let's talk antitrust. Do you think the environment has completely changed 180 degrees, or are we at some kind of hybrid of what Biden had?
Now, the changes are going to be incremental. So antitrust is this, in one sense, it's the most interesting thing and the least interesting thing at the same time. It's the most interesting thing because it's an area where Democrats and Republicans actually agree. I had tremendous amount of support from Republicans on the Hill, and a lot of young conservatives believe that concentrated economic power is a danger, and that if you want to pursue a deregulatory environment, you need a backstop, and that backstop would be a functioning market with healthy competition, where that will keep people in check. And so I think there will be some incremental shift, but it's going to be minor. And I think this has been a trend, even going back to my friend Macon Delrahim, where steadily we're seeing more receptivity to antitrust enforcement.
Which means what to CEOs, business leaders who are trying to evaluate what they can and can't do?
It means large-scale strategic M&A still has risk. Although I will say, going back to the economy, that the real difficulty in M&A now is pricing.
Yeah.
I don't know how people price deals with so much uncertainty, but the large, massive strategic M&A that will consolidate, 4 companies going to 3 or even 5 companies going to 4 are going to get a lot of scrutiny. But even under our administration, we blocked less than 1% of deals. There was still historic deal volume. It's just you didn't see the major transformative deals that would sort of consolidate vendors to, or consolidate industries to 1 or 2 or 3.
Would you take issue with someone that said many times Lena Khan would do something knowing it would be held up in courts, and by the time it really didn't think that there was merit to the case, but knew that she could delay it long enough to where it wouldn't happen? And it's not that, at least, is supposedly not going to happen anymore. The gentleman owner said, no, I'm not going to do it that way.
I guess I take issue with whether that happened. We at the DOJ did hundreds of investigations. We prioritized, and so we were very careful. A lot of the smaller deals that had no issues, we would just wait. We would make sure they went through. We didn't get in the way. We used our resources on the big issues: Ticketmaster, RealPage. Some of the airline deals that we felt would have a real impact on consumers and the economy, and then we essentially get out of the way for everyone else. And so I don't think we were really taking as long as people suggest.
There are some industries that are in such disarray, and I think of media and entertainment in particular, where new technology has disrupted. You've got streaming services like a Netflix or an Amazon or an Apple that have a lot of money that they can put behind it. And the old line media companies are struggling from it. I don't get the sense that this administration is going to take kindly to consolidation in that industry. I don't necessarily get the sense that under the Biden administration it was something they would have looked kindly at. And I just wonder why. If you're in an old line industry, not just media or entertainment, but any old line industry that's getting seriously disrupted by technology.
It really depends. And so we had a book publisher merger that we ended up blocking successfully because it would harm advances to professional authors, which we thought was really important. At the same time, industry does need to react and adjust to these technological changes. I mean, media, you're right, Netflix, Apple, Amazon, they're becoming the new
Jonathan,
NBC,
you got to
ABC,
stop
Fox.
talking. Look what you did to the market. We're down, now we're down almost, we were almost unchanged. Now there are some, there is something, what is the China flash at this point? China responding? Won't see it. We're going to have it, but you know, we're trying to do a live show, but something happened. It wasn't you.
All right, thank you.
We'll get more on that because it just happened. Meta.
Here's what it is. The China Finance Ministry is now saying that it will impose additional tariffs on U.S. goods starting April 10th.
So trade war.
They're looking at it's pretty brief. 84%. So yeah, this is game on. This
We're
is what
at 104.
we were kind of expecting. The trade war ratcheting up, and unless there's something to wind that back,
yeah, you can. So we got 70. You know, Fiji is ready to talk. So we got 70 countries that are ready to negotiate. But China.
Well, this is the problem. China's not going to go gently.
No,
right?
I know.
And I think we underestimate their willingness, not just to withstand long-term harm in their own economy, like you were talking about this morning. They don't have the same political system. Right. But I think we're underestimating their ability to galvanize other nations. And one of the things that really concerns me about our approach here is if we're going to take on China, we should do it with our allies in tow. We need Canada, we need Europe, we need major industrialized nations to essentially to organize around fighting China.
Not driving them into China's arms.
We're driving them into China's arms, especially on tech.
Yeah.
Right now that China has a DeepSeek and an AI base, the question is whose AI are people going to build on? And I'm really worried that we're going to see Europe and other countries welcome China's tech more than ours, and that can have a significant negative impact on our economy.
What's the total now? So they went up. Remember, went up 34 after we did some.
So 34 and 84 is.
What they started at what? They had tariffs on us already, and then they did an additional 34. This is above 104, isn't it? This is higher than what we're doing. How about Meta? Mark Zuckerberg has gone to great lengths. Do you think anything changes on that? When's that start? Monday?
Yeah, it would be borderline scandalous if.
Oh, gee, that would never happen.
Yeah, Zuckerberg went to the White House and then wound up with a settlement. And so, you know, law enforcement's supposed to be independent.
We've seen similar things almost happen, haven't we?
Well, I think that yes.
Suddenly TikTok is.
I think exactly, and so, but law enforcement, when law enforcement becomes transactional, then the rule of law.
Hard to prove.
Well, it's not that hard if you look at people walking into the White House.
So, and you think that, I don't know, you think Meta has to worry about Instagram or whatever? What's this one? What would they need to do? What's a remedy?
The remedy here would be, you know, breaking up Instagram. I think, you know, the FTC has survived their case so far, and interestingly, they have Judge Boasberg, who's the judge that has been taking on President Trump in other contexts.
So what is you put? What's Instagram? You put pictures online or something? How does that?
It's how you become an influencer, Joe.
See, I have no influence. Do you have an Instagram account?
I lurk. I don't post.
You like to watch?
Well, check, please.
Does this benefit the Democrats? Because to